Good morning, everybody. I'm going to set up a chat so everybody who has a chat capability on your computer, I'm going to have a chat where you guys can ask questions, make responses. We record this whole class, so you guys will all be able to grab a copy of it when we're done. It takes a couple hours because it's a 3-hour class to download into the cloud, and then we'll be able to send it out by tomorrow to everybody. So you will get a recording of this class, video and audio. So you guys can go back and, remember what we've talked about. This is a awesome class. We're going to go over a lot of material today, and it'll allow you to save it on your computer or your desktop or post it, whatever you want to do. And then we will ultimately put it up on YouTube, so you always have an access to it as well. So first 15 minutes of the class are registration. We're getting everybody logged in here. Sorry for anybody who didn't get their link. So we got that out to everybody. And I'm just keeping an eye on my emails so that I can see if anybody chimes in if they missed the link. So bear with us here for a few minutes while we get everybody signed up. Fairly big class today.
I don't know.
Okay, guys, so just keeping a quick update. Just going to go a couple more minutes and see if anybody else missed the link. Looks like we've got everybody taken care of so far. Just checking my emails to see if anybody missed it. And we'll get started here in a few minutes.
With all these faces, it looks like a modern day version of the Brady Bunch.
Or CNN when all the first stuff started. I remember that. They had a virtual football game or a basketball game with everybody in. So I remember seeing this. This is all right. So we're going to count down 2 more minutes. See if anybody else emails looking for that link, and then we'll get started. All right, guys. Good morning. Good morning to everybody. Thank you so much for attending. This is our renovation class, Renovation Specialist, Jumpstart Your Business for 2021. Many of you may have taken this class before in previous years, or this is the fun kind of class because it's personal invitation only. So Candace, myself, AJ, and Jason, all invited people today. So you guys are all special invitation people instead of teaching it for an association. I teach this class at all 40 associations in Florida, but these are the fun ones because these are invitation only. So thank you guys so much for attending. And for those of you who've been there before, we're going to try to get over some new material and everything that's changed over the last year and things that are going on. Welcome to you guys. If you guys make sure that you're muted, I will get here if I see it. What we're going to do is we're going to use, because we have so many people here, we're going to use chat to ask any questions. So I keep chat in a big screen right next to me. If you guys have questions as we go, please fire them away. It makes everything more interesting, but sometimes it's important to get your answer right now when we're talking about a specific subject. So if you guys chime in, have questions, I'm glad to do it. I'm also going to ask all of you to do a response. One of the ways that we keep track as a continuing education instructor, I record this class. You guys have to log in. We're going to make sure that everybody is registered and gets all their hours. But when we record it, we like people to respond. So when you guys send a chat answer, it may seem like a ridiculous question sometimes, but that's how we keep attendance as well. So we want the state to keep this open so we can all do e-learning. I actually kind of love the Zoom. For many of you too, I have to travel to 40 different associations, get in hotel rooms, drive for 4 hours to Miami, drive to the Keys, Pensacola's 7 hours. Like, it's a lot of driving, it's a lot of hotels and time away from my family and my company. So it's nice to be able to do Zoom. I think it's convenient. My wife's company, they all work from home now, and their sales went up 25% because she wakes up, she puts her tennis shoes on, some shorts, and gets right at it. She doesn't have to take a shower, do makeup, make any phone calls, get any disruption. So there are some benefits to the things that are going on today, and this being one of them. And Darlene, yes, we will get a copy to everybody. So it takes a couple hours for the Zoom to load up into the cloud. And then by tomorrow, either Candace, Jason, or AJ, or myself will all get you copies of this Zoom link so you can watch the class again. And that way you can always have access to it. We're going to put it up in our YouTube channel as well so that you guys will all be able to click on it. Just want to say hi to everybody. And thank you so much for attending in and seeing all the chat. Thank you so much. So let's get started. So we call this class Jumpstart Your Business because business is rocking right now. So it's something that's going on. It's kind of an anomaly. The good news is that our state is doing well and we are growing, and we've been growing for quite some time. But I want to have this class put together. And one of the reasons I teach this class is because we need to take advantage of opportunities while they're there and understand the challenges that we face every day. And one of the things that we're facing right now is a huge influx into the state of Florida. I hear varying numbers because that number probably goes up and goes down, but a minimum of 1,000 people moving to Florida every single day. Now that number was in 2019 was significantly higher than that, even before COVID started, because 600,000 people moved from the state of New York to the state of Florida in 2019. One state, 1 year. So when you look at it from a mind-boggling standpoint, is that people are flooding to Florida. They were doing that before any of this stuff started happening. And what's been going on as a trend is that people have been working from home. Companies have been reducing their office size and office square footage. And a lot of salespeople have been working at home forever. And it used to be that I had a friend who worked for NCR, National Cash Register. And in 1995, they were pretty smart and started closing their offices. They're thinking to themselves, listen, we've got all these offices. We've got, I'm going to throw a number out there. It's probably about $50 to $80 million a year in office space. How about we let the sales guys work from home and make sure that they're close to an airport? They can get access. They have, this is before the internet, so they have access to a fax machine. They've got a cell phone. They can hop on a plane and go meet any customer anytime. So that trend has been going on for about the last 10 or 15 years. As technology increases, there's really just no reason to be sitting in an office. A lot of times an office can be a disruptive pattern. And for many of you guys too, you guys used to go to the real estate office, didn't you? Where you'd have 30, 40, 50 people at your office in these huge offices. And this is my 28th year. So we used to call on offices. I'd walk into offices that had 70 or 80 people in them, handing out rate sheets and here's what the newest guidelines are today. So that has shifted as well, is that you guys aren't in the office either. So this isn't abnormal for many businesses. And it's been going on for about 10 years, really has escalated over the last couple of years because of technology, because of Zoom, where we are today. Zoom didn't exist a couple of years ago. And it's really taken off over the last 12 to 24 months. So these are opportunities that we need to take advantage of, and something that's not going to be changing anytime soon. I had a developer that I used to do loans for, and he's a northern guy out of Ohio, and they own a bunch of check cashing companies. He moved his home office from Ohio, which he had grown up in, and they moved everything to Florida. And then he decided he wanted to become a real estate investor on the side, just invest some money. And he looked at me one day in a meeting. He says, man, it's crazy down here. He says, but the one thing I never know, and this is when the market was turning a little bit back in 07, 08. He says, no matter what happens, everybody still likes the sunshine. So I never forgot that, because he was right. Doesn't really matter what's going on in the economy. Florida's going to do better than almost everywhere else, because even when things aren't going so well, isn't it nice to be at the beach? Isn't it nice to not to shovel snow? Isn't it nice to be at a place where you can go outside 12 months a year? So these are things that have already been going on in market trends. Today, we're going to be talking about FHA 203K. We're going to talk about Fannie Mae Homestyle. We're also going to talk about VA renovation. I'm going to give you the caveat that VA renovation is on hold right now. That happened during COVID, and understand VA is much more of a different animal. So when they have things and programs, they shut them down from a safety standpoint. They didn't want to deal with their VA appraisers going into houses. They just shut it down and put it on hold. It was a little bit necessary too, and we'll go over that today on some of the things that were going on with VA. They're like the new kid on the block. when it comes to renovation. So they're still getting their feet wet. And we'll go over the program because I do want to spend some time on it. Veterans are a very important part of Florida business. For many of you guys who are in the Panhandle here in Tampa, South Florida, there's a lot of military bases, there's a lot of customers, and we want to make sure we're taking care of our veterans. So we're going to go over it and spend some time today on VA and VA renovation. All right, so let's go to first slide here. So first, I want to talk about I'm sorry, I'm clicking through these buttons and I got rid of all you. So first I want to talk about kind of this class. So this class has been around for 11 years. I have just starting my 29th year in the business. I started in 1992. I discovered FHA 203K as I grew up in Annapolis, Maryland. I went to school. I transferred here to the University of South Florida, and of course, fell in love with Tampa. And I moved back to Maryland. I got a job with a company called Sears Mortgage. For any of you that are have been around for a while, we used to be part of the Caldwell Banker Network, and we were a fairly large mortgage company. We had 1,100 loan officers. This is 1992, 1993. And we were the 7th largest mortgage company in the country. And I got my feet wet, went in, worked hard, started making money, did pretty well in the mortgage business, and decided I wanted to buy my first home. And what happened is up in Annapolis is close to DC, Virginia, Baltimore, and it's super expensive in Annapolis. So a starter home back then in 1992 was $400,000 to buy a home. And I knew that I couldn't afford that, couldn't make that, didn't make enough money to qualify for anything like that. So I started looking at houses that needed work and understood that some of these houses needed roofs and major remodeling, and realized the only way I was going to buy a home in that area was to do a renovation loan. And I kept asking my boss, who had already been in the business 25, 26 years, how does somebody buy a house when the house needs work? He says, well, we work a deal with the seller and they fix it up, and the buyer gives them money and it makes non-refundable. And I'm like, well, isn't there just a renovation loan? He goes, yeah, we have this thing on the rate sheet. So he told me about FHA 203K. He said, but nobody in our company's ever done one out of the 1,100 loan officers. He says, but HUD is right around the corner and maybe you could get some education there. So back then in 1992, we actually would underwrite a loan. We were a national lender. We'd get it approved from our underwriting department. And then we would send the last stage of a loan was to send it to HUD. So HUD would actually sign off on every single loan in 1992, no matter if you were a large lender, small lender, broker, they had to do the last little underwriting and approval. So when you think loans take a long time today, imagine 90 to 120 days on most closings back then. So I commuted into HUD for about 90 days. I did every other day. And I sat with underwriters that were in DC, but they were doing HUD 203Ks in many areas. So they're doing them in Chicago, New York City, New Orleans, Los Angeles, San Francisco. Some of the big cities were doing 203Ks. So I got to work with underwriters to see how this program worked, ask questions, figure out how everything was. And I decided, I got permission from my company to be the first person to ever do a 203K loan. I did it on my own house. So I went under contract for a house that was $1,890. So when you talk about historic homes or homes that need work, boy, this was one of them. The roof was leaking, the basement was flooding every time it rained. This had old radiator heat, so it had a radiator system like a car that went throughout the house, had a boiler room. The kitchen was trash, flooring was in really bad shape because the roof was leaking. But I was able to secure the house for $185,000. Now, this is in a really nice area of Maryland, right in between Baltimore and Annapolis. So I got it for $185,000, and many of the homes selling for around there were in the $500,000, $600,000, $700,000 range even back then. So I got it for $185,000, and I went out, and back then you had to get 3 estimates from 3 separate contractors. So it took a while to get the estimates. I got all the estimates in and we submitted everything into underwriting. And back then, actually, HUD chose which contractor you're going to use. And what did they do as the government back then? You were required to use the cheapest contractor. So that was kind of a disaster at the time that HUD would make you choose the cheapest contractor out there. And then so I submit the loan to underwriting. And one of the best days that I've ever had was the day the appraisal came in. So I bought this house for 185. And I'm sorry, I'm going to have to get out of the screen here real quick. Bought the house for 185. It needed $85,000 to fix it up. And the appraisal came in. So I'm at about $270 and I've got to $270,000. The appraisal came in for $435,000. So when I came in, I have $130,000 worth of equity and I'm 23 years old. So I understood from at a moment's notice what was important and how this was such a great program that could be used for buyers, because I'd never seen anything like that before. You know, we had done appraisals and people might have $5,000 worth of equity or 10 grand, but I've never seen anything like that. So on the buying side, I discovered how important this was and really that this is something that I wanted to focus in. I also figured out very quickly that this is something that could be useful for the agents that I work with. Already after a year, I had a couple contracts that had canceled out because of roofing inspections or the heat didn't work or foundation issues, that type of thing. So I really kind of understood, hey, this is a product that really can be beneficial to listing agents, to selling agents, putting deals together, whatever. So I really kind of focused on this program. I realized it was important. It took a little longer to close. And man, I just immersed myself into it. So I'd go around the local real estate offices and I would teach the classes. In 1996, I became a HUD certified 203K instructor. And I taught lenders how to use this program and have continued to do that. I've helped some national lenders. But over the last 29 years now, I've closed over 5,400 renovation loans. So this is something I'm super passionate about. I love to teach the class and I do this on a daily basis. We're talking to 10, 15 customers a week about how to do these programs, ordering appraisals, working with contractors, getting it. It's kind of makes the mortgage business fun. So yeah, I've done other types of loans, but this is the one I'm really excited about. It's the one I like teaching. It's the one I teach every customer about. So I don't care if they're calling in for a regular VA loan, I'm sending them information about renovation loan. Why is that kind of important today is everybody watching TV today, how many real estate channels or shows or Love It or List It, Fix It Up, This Old House, man, they're everywhere. So these are what reality TV shows are about. And it's really helping our business, to be honest with you. Every time a show like that comes on, people get excited. They see what's possible in a house. They see what the kitchen can look like instead of what it does look like. So these are some of the things that are helping our business today, and wanted to spend some time on kind of that background. So this class, I put about 9,000 realtors through the class, and that is a drop in the bucket of how many realtors that there are. So when we're done this class today, I want this to become part of your dialogue with your customers. I have never walked into any single meeting. I've never met a buyer that wasn't interested in at least receiving this information and knowing that's an option. I never said, whoa, I don't want to have anything to do with fixing up a house, because the reality is that house could be perfectly ready to go, but your customer is going to go in and pull out the kitchen because they might be a foodie and they want to have their specific type of countertop or their sink that they want to do, or they want to have a pantry that's much bigger. No matter what the house looks like, people are going to put their own finishing touches on it. And this will allow them to do that. Let me go in here and see if there's any questions so far. So let's see, the appraisal will be on the after improved value. So we're going to talk about this in two different ways today. There is a purchase renovation product, and the same product is also available for refinance. When we're doing a purchase, we do not care what the as-is value is. And I'll say that again. We don't care what your customer paid for the house. We only care what it's worth when it's finished. So when we order an appraisal, we're going to order an appraisal with the purchase agreement that you put together. We're going to send them a 203K inspection report, which details all the things that need to get repaired. And then we're going to send them the contractor bid, which is a line item bid, which breaks out every single thing that's being done to the house. We're going to do countertops. We're going to put in new cabinets. We're going to put in new flooring. We're going to add a bathroom. We're going to add a garage. They'll get a floor plan. If we're going to change the floor plan and add bedrooms and bathrooms, we're going to send a new floor plan to the appraiser so they know what the new square footage is going to be. If it's a major construction, we may even send the entire plans to the from the contractor, and the architect will go to the appraiser. Let's say we're putting on a second story. We'll send them elevation. So all the appraiser's getting are purchase agreement, new floor plan, bid on the repairs, and they're only going to be looking to comp houses that have already been fixed up. So they're looking in the neighborhood. If some homes have already been remodeled, they have new kitchens, they've been upgraded, they're looking for the after improved value only. So that's what's important to know. On a refinance, when it's a 203K, we'll actually do an as-is appraisal and an after improved. Now, the as-is appraisal is a benefit to the client only, because what we're trying to do, 203K allows you to roll in on a refinance all the closing costs, all the prepaids, everything into the loan, provided you have at least 2.25% equity before you start. So the only reason we do an as-is appraisal on a 203K is to allow our client to finance closing costs. So if you have a customer, and probably many of you do, that you put into a home regular FHA, and I'm sure they told you, well, someday we're going to do the kitchen, and we're going to do the roof in a couple of years, and we're going to do those floors, and we're going to make the closet system. When you check in on them 5 years later, have they done it? Nope. And there's a reason why they haven't done it. It's called money. So it's so simple, okay? Most people buying a house, and I don't care if it's conventional or FHA or VA, man, they're beg, borrowing, and stealing to get their money for a down payment. Some of them are cashing in 401ks. Some of them are pulling in money from stocks and bonds, and maybe they got some inheritance money, or their parents are giving them a gift. But I can count on two hands in 28 years the people who had 40 or 50 grand in the bank after closing. Now, you guys might do cash buyers if it has $1 million and $500,000. They just never seem to make their way to the mortgage companies. So maybe it's they have their private bank information and that kind of stuff. But it's just very rare that people have a ton of cash sitting in the bank. And things are expensive. Life is expensive. I've got a daughter in college. That's $3,000 a month before I start my day. Okay, so I know things are expensive, and it's hard to save money for that roof that's going to be 10 grand, or the kitchen that's going to be 15 or 20 grand. So that's one of the issues that's coming up too. So some of these other questions, let's get to them. Investors. So we're going to talk in great detail about FHA and VA renovation are only for primary residence. So you have to live in the property. It's got to be your primary residence, and that's it. On Fannie Mae Homestyle, we're going to spend a lot of time. Fannie Mae Homestyle allows second homes. So if you have a client that lives in a house in New York and wants to buy one here, they can use the renovation product as a second home. It's only 10% down, and they can do it as an investor. And the minimum they say is 15% down in the guidelines, but realistically with the new Fannie Mae guidelines, it's really 25% down, because Fannie Mae is already sounding the alarm on investment properties. And we're going to talk about that a little bit later. Now, this is for investment properties: buy, fix up, rent for at least 1 year, and then sell. This is not a flip product. None of these products are for flips. And here's why. If anybody allowed flips, they would lose everything on the mortgage side. There's not enough. When we're charging 3% or 3.5% interest rate, it's just not possible to make any money long term. Okay, so Fannie Mae is not designed that way, nor is FHA. So the minimum is 1 year. Now, the 1 year is from the day you close. So when you buy a house on May 15th, when can you list it? May 15th next year. Okay. So that's buy a house, fix it up. If it takes 6 months or 9 months, that's okay. You rent it out for 3 months and then you sell it. Now, why is that important on a flip? Has anybody ever done a flip loan? Everybody send me an answer. If you've ever done a flip loan for a client and what the interest rate was. Everybody send me a chat real quick. Cindy's got an answer. She's saying 10%. So most of you have never done one. Interest rates on a flip loan for a perfect credit customer, 10, 12, 13% interest rate, plus 2, 3 to 5 points. If you're an investor, if you're a realtor and you're working with an investor and they do a flip loan, they will never do a deal again. You cannot give 15 to 18% of the first profit on a house to someone else and make money. You just can't do it. It's not physically possible. So the people that are doing flips, they might have inherited a loan, or unless they're buying a house 50 cents on a dollar, you just can't give up that kind of profit to the guy who's lending you the money for a couple of months. It just doesn't make sense. Whereas this program, you're buying it, let's say rates are in the mid 3s right now. You're buying it, you fix it up, you hold it for one rental cycle, which will help you with taxes, insurance, interest, whatever. Now you're making profit because you only gave up 3% for a half a year. The other more, once you rent it out, now your interest getting taken care of, your property taxes, your homeowner's insurance, all the above are getting taken care of. That's profit. It's also a different tax basis to hold it for 12 months or 24 months or long-term gains. So there's some benefits there on the investor side that we will go over later. So Zach mentioned points up front. Never seen a flip loan that didn't have at least 2 to 4 discount points on it as well. So those are the points up front immediately at closing. So it gets super expensive to do one. And then somebody asked what the distance was for a second home. So second home, rule of thumb is 100 miles is what it's kind of the written rule, unwritten rule, what they've been using for a decade. Unless the second home can be in your same town. If it is on a natural resource, it's on a golf course, it's on the beach, it's in a high rise that has sports and that kind of stuff. So a true second home must be 100 miles from you. You have to occupy it for at least 18 days a year, I think is the IRS rule. And then it's got to be on a natural resource if it's less than 100 miles. So you live in the city of Tampa, you've got a beach condo out of Clearwater Beach, totally fine. That's a second home. Now you can't go in and rent it for 12 months because they'll figure that out right away, but you want to occupy it 18 days a year, do Airbnb, all that stuff is totally fine. Okay. Okay, Sandy, so I hope that answers your question. All right, so let's get back into it. Why are we here? The biggest problem we're having right now, low inventory. You guys all have it. Everybody's having to deal with it right now. It's not going to change. I've got bad news for you. It's not going to change anytime soon. So the low inventory is because we have people moving into town. We have people who are having success. Unfortunately, we've got people in restaurants and bars and that type of thing. They're still kind of getting back up to speed, but many businesses are rocking right now. People are making money. Our business grew 25% last year. We've hired 3 new people here at our company. I'm sure you guys, you see the activity, you see the houses flying off the market. People are not as afraid to get out of their house and go look at houses as well. So those things are all good. But the supply thing is just going to be an issue, and it's going to be an issue long term. I am one of the biggest fans in New York City. I grew up in Annapolis. It was a 3-hour train ride. I love the city. I love the shows. Why would you live in New York City when everything's shut down? They have destroyed these cities. Detroit, Chicago, New York. They're done. So anybody of reasonable intelligence is going to be moving. They're going to move to Georgia. They're going to move to Florida. That's going to continue, and it's going to escalate. It's going to get faster. It's going to get stronger, and it's going to continue. So we'll take advantage of it. Yes, we want you to come down here. Now, the advantage for a New York buyer coming down here is the huge salaries these people come down here with. They're getting paid New York dollars and moving to Florida. Our median income for a single individual is in the 40s. Theirs is in the 80s, double the income. When a school bus driver retires from New York, you know how much they make in the state of New York? 80, $90,000 in retirement. A teacher makes 100, 110, a fireman 120, a police officer 110, 120. These are basic retirements from these states. So New York, Michigan, Pennsylvania, New Jersey, they've been giving out these huge pensions for decades. And yes, we would love both of their family to come down here with 200 grand and spending it here, don't we? Yes, we do. So we like the people moving into town. They're good buyers. They're high income. They're buying higher sales prices, which is good for us, right? You guys get paid on the purchase price. So these are some of the things you need to be thinking about. I write it out today. Write down yourself a little note. How am I going to contact my company's agents in New York or New Jersey or Pennsylvania? How can I get some of these referrals? What can you guys do? Can you put on a Zoom class for your Caldwell Banker office that's up north, or your EXP Realty? These are things that you could be doing today. How am I going to get some leads from up north? What's a good way? Is there a Facebook page that I could make? Hey, relocating to Florida. Or if you guys are from Pennsylvania, maybe you're from Allentown, Pennsylvania, you start a page up there. Anybody thinking about moving to Florida? These are some ways that you guys can start generating business today. California dollars. Trisha's talking about that. That's been happening in California for a long time. People have been moving out of California to other states because it's just so expensive as well. Okay, what are some of the other things you happen? Anybody have a contract that they've canceled in the last 12 months when a home inspection? Please send me a chat if you canceled a contract and what it was for, what actually caused the contract to cancel. And remember, this is how we do attendance. So please, everybody, just send a quick chat. If you've done that, you can just say no to. Zach says a septic system. All right. Too many inspection issues. Seller did not want to make repairs. So that's something that's been going on for a couple of years. We started using these as-is contracts back in 2008, 2009, because people didn't have equity. When all that stuff happened and everybody was losing their equity, we went to the as-is contract because sellers couldn't afford to make repairs. For those realtors who have been around that were here in 05, 02, 2000, and the 90s, you used to send a home inspection report to a seller and they used to fix everything. So you say, hey, I want a new roof, they'd replace the roof. You need an air conditioning, they would replace the air conditioning. But that's how real estate used to get done. Now that we have an as-is contract, there's a lot more things that seem to be coming up to cancel contracts. Painting is mentioned, a roof is mentioned, termites, mold issues, bats. That's no fun. I don't like bats or snakes. Getting good insurance rates. Okay, so that seems to be a big thing these days. It's one of the first things out of the bat we do with a renovation loan. It's one of the first things out of the bat you should do with every loan. As soon as we get a contract ratified, you should be getting homeowners insurance quotes if you haven't had the client already doing that. So big changes coming in insurance industry. You know, they got hammered last year with the most storms they've ever had. Some insurance companies are pricing themselves out of the market intentionally, but I've seen lots of carriers that have jacked their prices up. Some have doubled them. So it's important to get a good resource. If you guys email me when we're done, I'm glad to always refer a couple of good insurance agents. I have a 4 or 5 that I like to price things with, but I even noticed the 4 or 5, they work for different companies and they have vastly different premiums depending on where the house is located. So always important to check many sources on insurance because that's a moving target. On the renovation side, we have a solution. You will never have an insurance problem if you're doing a renovation loan because we have a temporary insurance that's available for any home, any customer, anytime called a builder's risk policy. So when you have a house there, the roof is caving in, it has termite damage, no air conditioner, plumbing leaks, we will give them a builder's risk policy for 1, 2 to 6 months while they fix all the repairs, and then they will get a new policy after all the repairs are completed. So we have a solution if you have an insurance problem to go renovation loan. So that's an important thing to know. The second important thing to know is who has customers that are on the lower end of the spectrum? Anybody have a customer that's less than 200,000 in the last 3 months? Sandy has, yes, all of us. So far, yes, for everybody. Your customers that are buying less than 200,000 should be exclusively looking for renovation properties. And here's why. Number one is that there's no such thing as a perfect house at $150,000. Doesn't exist unless you're in a very remote area. Okay. Sebring, let's say, you might find one. Okay. If you're near any one of the major cities here in Tampa, no such thing as a $150,000 perfect house. The second is those are the houses that don't get maintained. So, when you talk about like an old Volkswagen Bug, well, they last forever because people maintain them because it's not very expensive to maintain it. Somebody who owns a $120,000 house is not going to go put a 10 grand roof on. They're going to do everything they can to not do that. They don't paint their house every year. They don't touch it up. They don't address wood rot when they see it, even though it could be $100 today. That could be a $5,000 problem 3 months from now. So people on the lower end of those sales prices do not maintain their homes. The things that need to be fixed are exponentially expensive as a percentage of the house. And then the third thing is insurance. And I want you guys to write this down. We are going to approve your buyer PITI, principal, interest, taxes, insurance. If I can lower their insurance premium by replacing a roof, what do they get? Higher buying power. So if your client is going to have a $2,500 insurance bill because the roof has 3 or 5 years left, but I can put a brand new roof on, it's 10 grand. That's $50 a month in their mortgage payment, but I'm going to save them $120 a month in their insurance, because insurance isn't just 30% less or 40% less. Sometimes it's 60, 70% less with a brand new roof to current wind loads. So you have more buying power to go 203K than you do for any other product, because we can lower the insurance premiums and do the things that might need to be done, like upgrade the panel, that type of thing. So it's not always roof. Sometimes it's the electrical panel that becomes an issue and raises the insurance. So there are certain electrical panels that have been deemed unsafe or long-term. Yes, you can get insurance, but it's 3 or 4 grand a year, and that will ultimately go away. When we do the renovation loan and replace that electrical panel, they're getting the benefit of the new price. And that's what we use to qualify them. And that's what they use for their mortgage payment. Minimum repair amount for FHA, 203K is actually 0, because we can do a streamline or limited review. Most of the time, I'm going to tell you, you probably don't want to do it unless it's 5 grand. If you've got $1,000 worth of repairs, work it out with a seller. There's just no reason to go through all those steps, unless you're going to do other cosmetic stuff. So remember, with renovation, we can do needed repairs, we can do cosmetic repairs, and we can do any combination in between. So the house could be perfect, but your customer wants hardwood floors. The house could be perfect, but they want to redo the kitchen. Or the house could be trashed. It can be any combination thereof. So it doesn't have to have needed repairs. Okay. Clients that are buying lower don't have a lot of money, and renovation costs seem like it blow it out of the water to qualify. So great question. Renovation costs for a renovation loan are all financed. Any single fee, inspection fee, 203K consultant, title update, all these things are rolled into the loan at 100%. There is no more cash out of pocket for a renovation loan than there is a regular FHA loan. The only exception is you're a slightly higher down payment. So if you bought a house for 200,000 and you borrowed 50 grand to fix it up, your 3.5% down is based on 250, not 200. So there's a little more down payment. But any renovation cost that's involved in these loans is rolled into the loan 100%. So this is designed to be low cash out of pocket for every borrower, every time. We'll just take that out of the equation. There's never going to be a time where they don't have enough cash to buy renovation, but they do on a regular loan. So great question. Thank you so much. Condos, townhomes, and villas, we're going to go over in a couple slides. Is there a must-have? There sure is. So, and we'll just go over this briefly and we'll go back more. When the inspector comes out, they're going to give us a list of the must-haves. So the 203K consultant is a licensed home inspector, trained by HUD, used by VA, FHA, and Fannie Mae. But they're going to give us a checklist of everything that's needed to get done for financing, which is the most important issue in any deal. It's not necessarily important what the home inspector feels, it's what the lender would feel is important. So we do get a list. It's the first thing out of the box, and we'll go over that process. Contractor handyman, we're going to go over that in a little bit as well. So yes, it's a little harder to get them. We can help you if you have a client for sure. Make recommendations or whatever. They're busy. There's no doubt. There's a lot of construction going on, and important to have and create a team. So when you guys start doing these and you do a couple, you've got a contractor. Now you're giving your contractor 3 or 4 deals a month of clients to talk to. Guess whose phone they answer first? Yours. So you want to create a partnership. Also on the mortgage side, that's what we have always done, is created partnerships. You know, we're not allowed to have financial interest, but we certainly have what we call business partners. You know, a contractor we can lean on, a roofer we can lean on to get something done quick, an insurance agent. So you guys are creating a team, and that's the end result. Is that's the most important thing. Boy, when I send a contractor a referral, they're getting called back that day because we send out, I think last year we probably sent out $2 million worth of referrals to contractors. So yeah, they pick up the phone. So when you give them that kind of business and you have that workmanship with them, it'll be a good team approach for them. Okay, what are some of the other things that are happening right now? Survey issues. I don't know if you guys have ever had it, but surveys create an issue. If there's a fence that's been built over the property line, a structure like a shed. We had recently a deal up just north of Tampa. It had a shared garage, which was with the next door neighbors. So the answer to that was pretty simple. No one has a garage. So between you and your neighbor, if you have a garage right on the property line, neither one of you owns a garage, and neither one of you can close on a loan until we fix that. So you can't have an encroachment like that and get financing. So we would have to build a garage next door. And if your deal with the next door neighbor is maybe you build them their own, you know, who knows what has to be done. But we had recently a survey exception in the last couple of months where it was a manufactured home out in the middle of the state, and the well was too close to the property line. So there's some health codes that it has to be within a certain distance of the property line. And this one was 4 feet from the property line. So we had to dig a well and put a new one in. We've had to put septic systems in because multiple homes shared a septic system. So those are kind of survey issues that come up. Sometimes there's a property that has an encroachment. A lot of times pool enclosures. Somebody builds a pool and they don't get a permit to do the enclosure. Sometimes that's within the setbacks that they need to do. So those are kind of the survey issues that pop up. And then title issues. I don't know if you guys have ever had this, but sometimes you guys have open permits. Open permit is actually a title issue. So it cannot close because the open permit is an issue, or a notice of commencement from a contractor that hasn't been closed out. That is also a title issue. We can correct those in a renovation loan. So if you have an open permit on a house from 2010 and your title company is saying you can't close and your lender is saying you can't close, we can do a renovation loan, show in the bid that they're going to open up that permit, get all their inspections, and close out the permit. We're going to let them close as is with the open permit. So we do that all the time. It's a great way to bail out open permit situations. And while they're there, do the other work. You know, usually open permits is for something, an older house that they did something and the contractor just never followed up to get their final inspection. Usually it was unintentional. It could even be the city forgot to record it. But if you're in Miami, you're in South Florida, man, you're never going to close out a permit without getting a new contractor to open it up. They just won't close stuff out. So certain cities are really tough about closing out permits, but renovation loan is the answer on that. What's some of the other issues that we're having? Let me get some of the contract comments here. Okay, permits. All of our permits, any work that we do, if the city or the county requires a permit, we're going to require a permit. So that's the only way we can enforce a contractor does it the right way. So we're going to make sure that they open up the permits at the first draw, or we're not going to pay them. And then we make sure that they close their permits out at the last draw, or we will not pay them. So we make sure that all those are happening. In addition, we're sending that 203K consultant out to take pictures, certify everything's done. The home buyer, everybody's making sure that that's done. But great question. We do require permits. Collier County, I understand that also very tough to, they don't let open permits just go away. They make you open them up and close them out. And those are the high wind areas, to be honest. They're looking at it from a liability standpoint. If there's an open permit on the roof and the roofer didn't do it right, they could be liable. They're letting the homeowner live there. So that roof could fly off and go to the next door neighbor and hurt somebody. So there's a reason why they don't let you close out those permits. Electrical, big time. If they don't close out electrical permits, somebody could be grabbing a wire that isn't insulated or getting hurt. So those are pretty big issues. And okay, so Collier, you just had one where the owner just passed. Is it the owner just passed away, Jamie? Or they just passed the property? Let me know that. Whoops. Okay. And if someone is currently on a VA, so when you do a refinance on these renovation programs, it does not matter what type of loan you have now. We can move VA to FHA, we can move VA to conventional. It all depends on what the value is going to be when we're finished. So if they owe $200,000 today, they're going to borrow $100,000 to fix it up. We would look to the loan program that's going to be the best suited for them. So Fannie Mae Homestyle, if you have 5%, 10%, or 20% equity, gets reduced or no PMI. So we will always try to take them Fannie Mae if we can, because the PMI will go away, or it will be lower than FHA. If it has to go FHA has the normal PMI, which is there for a lifetime. Okay, so why else are we here? Property has home inspection issues. We already went over. Lots of properties need roofs. Can't get insurance, or the insurance is too expensive. Flood zone requirements. Flood zones are constantly updated. We can raise houses above flood level, jack them up, put them on stilts. We can put them on higher foundations, that kind of issues. Appraisal issues. Appraisal issues are a big thing today. Here's the best part about appraisal issues. Number one, I want you to write this down. FHA 203K finances 110% of the after improved value. So that means when you buy a house for $300,000 and it needs $30,000 worth of repairs, we're at $330,000. It only has to appraise for $300,000. So what does that mean to you? We've got wiggle room on every single FHA 203K. No matter what the purchase price is, I get 10% above that appraised value. So if it even only appraises for $300,000, we're going to give you 10% repairs as a gift, meaning it doesn't even have to improve the value. Some people are going in. We have currently a customer that's working on handicap accessible improvements, which may not necessarily improve the value, but the functionality. Sometimes your client is the first one in a neighborhood to fix something up, so we get 10% wiggle room. And the important thing is that if you have an FHA deal that's underappraised, generally there's three problems with that. Number one is it might have appraised because the house needs work. So all the other comps might be in nicer condition. So we'll fix that by fixing it up, because now we're going to have repairs being done, and maybe now it's the same, what they call C2, C3, or C4 condition, and quality of construction, because we're going to fix those items. So it might raise the appraisal just by doing that. The second is that if you have an underappraisal for FHA, and let's say you're 10 grand low, we can go add an air conditioner bid and switch it to a 203K, and then it closes automatically because we have our 10% wiggle room. So if you ever have an FHA deal that underappraises and the seller won't come down in the price, go get an air conditioning bid, a flooring bid, switch it to 203K, and now you're good to go. The third part of that is the appraisal equation. I would like to tell you that all appraisals are the same and all appraisers are the same. They are not. Not even close. In fact, in 29 years, I've never seen two appraisers get the same value one time. We do 60% of our business is renovation. And a lot of times, I even had one 2 years ago, a little bungalow over here in Safety Harbor, which is a beautiful place just outside of Tampa, very quaint little downtown area. It's a gorgeous house. And the first appraiser came in, we were going Fannie Mae Homestyle. He already owned the home, was fixing up this little bungalow to make it awesome, literally walking distance to all the restaurants and everything. First appraiser came in at $203,000 as the after improved value. So we had to switch it to 203K because he only had about 5% equity when he was done. And we had to reorder the appraisal because it's FHA. The new appraisal came back, same house, same scope of work, same within 2 weeks of this other one for $303,000. It was $100,000 difference, two appraisers, same house, same scope of work within 2 weeks of each other. So I'd like to tell you that appraisers are the same, but they're not. Some of them are 20 grand less, some of them are 30 grand less. Maybe it's just because they knew it was a second appraisal. I have no idea, but the second appraiser is usually higher and always different. They're never the same. So sometimes just by pulling it from that lender or that specific appraiser, we get to order a new renovation appraisal anytime we change the scope of work. And it kind of makes sense why. If we're going to do an appraisal and we're just remodeling the kitchen, now that's an appraisal of house with a new kitchen. If we're going to go in, gut all the bathrooms, add some square footage, fix a garage, do some other things, that's a different appraisal order because it's a different scope of work. So we get another bite at the apple and another opportunity to get a new appraisal. So it's one of the cool things. It's the only time in FHA where you can have a second appraisal and use the new one if we change the scope of work. So those are some cool tricks of the trade that we've been learning, but it'll fix all your appraisal issues. And then, like we said, the last thing is a lot of times an appraisal's coming in low because that house just isn't as nice as the other ones that are being comped out. Those other ones might have all been remodeled in the last 12 months. So those will fix some of the issues. Illegal additions comes up a lot. Illegal additions, the most common you're going to see are the garage that was converted to a bedroom without a permit. Now, appraisers are supposed to be looking for that. So if it looks like that room used to be a garage and they didn't do necessarily such a good job, and you can tell maybe that's a step down and they didn't level the floors or whatever, the rule is that the appraiser has to condition for permits to show that that was a legal addition. So you're going to see that a lot moving forward. It just started about a year or two ago, and they're going to start enforcing it. So we can either convert that to being a garage again, or we can go in and get the permits. Now, garage additions were usually fairly inexpensive to do it the right way because they already had a roof, they already had a floor. As long as that floor elevation is above the crown of the road, 18 inches, they're probably going to be fine. And then usually it's going in and fixing and adding some electrical outlets, making sure the AC ductwork is correct, any plumbing or window issues, and then tie downs. So sometimes it could be as inexpensive as $3 or $4 grand to fix it the right way. So we see that a lot. And then the second thing I see a lot is patios. People convert their patios. I've seen people take the whole backside of their structural wall out of their house and not replace it, where appraisers were scared to walk in. So people turn their patios into square footage without getting a permit. Happens all the time. And they just, you need a permit to do that. So we need to make sure the foundation was proper, the tie-ins are proper, AC, electrical, that kind of stuff. And so there's really, unless the property appraiser has had that as living square footage, we'll call that's kind of the grandfather rule. If the property appraiser has already shown that as being square footage, you're going to be fine. But it's something that's been done, let's say in the last 8 to 10 years now with technology, because they can have pictures now. Property appraiser has digital everything. So hard to get around that stuff today. We already talked about DTI, borrower pre-qualification. You can get a higher DTI with renovation loans because we're going to fix the things. Our underwriters will give a 54 back ratio to somebody who's replacing their roof and doing insulation and replacing the windows, because they know that their expenses are going to be lower and these aren't going to be big ticket items. Underwriters look at everything in a loan. So does Fannie Mae and FHA. Many people go to foreclosure and short sales and get behind on their mortgage payments, not because they lost a job, but because they didn't fix these big ticket items. If you don't have 10 grand from the roof, where are you going to come up with it in 3 years? Well, now the $10,000 roof isn't 10 grand. It's how much? It's 20 grand, because now you've got drywall wet, insulation wet, water getting behind the cabinets, hardwood floors getting damaged. So a $10,000 fix that we could have just done a roof at closing now becomes 20, 25 grand worth of repairs. These things can take your customers down. Buyer expectations of the budget. By financing renovation loan, so many people in the past have historically went and put their 20% down on their home. The few and far that maybe here of us here, we don't see that much. Somebody actually does have 20% to put down. They generally don't understand how much renovations really cost. So maybe the last time they did a home, a kitchen might cost 5 or 8 grand. Now they're 15 and 25 grand. The appliances are 8 grand. The countertops are 5 grand, and they get a sticker shock. So what happens? They go put all their money on the 20% down, and they don't realize it's going to cost them 50 or 60 to fix this thing up the way they want it. So that creates an issue for many clients. What we're doing is we're combining the two together. So when they buy that house for 300,000, if we put that 60 grand, now it's 360, they're putting 20 grand down of 360, which is $72,000 down. If they put 20% down, 300, it's 60. And now they need 60 grand, they need 120 grand cash. So we don't want them to do that. We don't want them to go max out their credit cards to go do those things. I see people do it all the time. We'd rather combine the two into one loan and have them put 20% down on the total. Cash flow is everything. It's nice to have reserves. Nice to have reserves for retirement. You guys are in real estate too, just like me. I'm working. Got to be able to put some money away for savings. And the way to do that is you finance your home repairs. Put the cash away for when you retire. Okay. Last two things I want to go over on this slide, then we're going to take a quick break. I want to tell you two things, and these are absolute real estate sureties. There is no such thing as a deal on a perfect home. Say that again. There is no such thing as a deal on a perfect home. And what does that mean? Never in any town or history has anybody walked into a house and for the most part paid 50 grand, 100 grand, 200 grand less than what the home was worth. Now, does that happen in $1 million homes? Sure. Does it happen for, some properties? Absolutely. But for your customers, they're never going to walk in and get the perfect home and get a deal on it. There's too much demand. There's too much customers that want those really nice houses. You guys probably already dealing with it now. Highest and best offer, multiple bid situation. Those are things that are going on. And then the other thing is the probability of closing on a timeline. The longer the timeline, the probability approaches zero. And what do I mean by that? You have a customer today that's approved for $350,000. I'm going to ask a quick question. And interest rates right now are 3.25%. Last year, rates in 2020, it's before COVID, they jumped from 3% to 4.625 in 3 weeks. Your customer at 350 that's approved at 3.25% today, how much are they approved for if rent rates jump up to 4.625? Everybody give me an answer. How much is your customer that was 350 at 3.25? How much do they qualify at 4.625? And you're going to be shocked at the answer. 275. If you can't find your customer a house at 350, what's the probability you're going to find them one at 275? Zero. Zero is the probability. Okay. Every day that you're in this business, that you have a client that wants to buy a house, every day that that takes longer is a disaster. It increases the probability of that customer never closing. That's just the interest rates. So your customer at 350 going down to 275, lose, lose. The other thing that happens is people get laid off. They get job transfers. They have a medical issue. They have to buy a car because something broke down and now they need a $600 car payment that they didn't have. Now they're 100 grand less than qualifying. They meet a new boyfriend, meet a new girlfriend, go through a rocky time in their financial situation. They start dating a realtor. Now they want to use their realtor. Their brother quit their job and wants to be a full-time realtor, and now you're going to lose it to somebody else. On a long enough timeline, the probability of closing your client is zero. It's an emergency to find them a house today at good interest rates, at whatever's out there. It's more important to find them a house that works for them, and it doesn't matter what the condition is. I've bought 6 houses using this program. 6. 3 of them, I never walked into the inside of the house before I wrote an offer. 2 of those were full price offers, sight unseen, because I knew the neighborhood. It doesn't matter what the inside of the house looks like if you know renovation loans are possible. In fact, for me, the worse the house is, the higher probability I am to buy it, because I know I'm going to get a good deal on it and I get all brand new stuff. We're going to take a 10-minute break so you guys can check your emails, take a break, take a second, and we'll be back in here right now. It's 10:10, so we're going to come back in at 10:20. So I'll see you guys in 10 minutes.
Andy,
Yes.
for some reason, I'm not seeing your slides. Is there something I need to do on my end?
When we come back, I'm going to put them on.
Okay.
So it's kind of hard to toggle between the chat and the slides, because my slide, it takes up my whole screen and then I can't see the chat. So I'm going to have to toggle back and forth. I'm sorry
Okay.
about that.
That's okay. I wasn't missing. That's all I was looking to see. Was
No,
I'm missing the
ma'am.
slides.
Yeah,
Okay.
I'll try to do both, but I like to keep chat because lots of great questions coming in. So sorry about that.
That's okay. Thanks.
And I will send everybody my slideshow as well. So as
Perfect.
part of your certificate, everybody's going to get this slideshow presentation as well.
Thank you.
Okay.
Hey, how are you?
Hey, guys, we'll get started here in about 1 minute. Just had somebody that missed the initial sign in, so I'm sending him something real quick. All right, guys, we're gonna get started. Sorry, I had a couple people that wanted to jump in the class that just sent me a text and missed the email, so sorry about that. Hey, Sandy, we will, I'm gonna have AJ type in here. AJ's on this class as well. AJ, will you send the link to everybody, click everyone, and put in the link where they can register? Anybody who is on this class that hasn't registered, please go in and register. Make sure we have your license. So we need your full legal name. We need your first and last legal name as it appears on your license, whether it's a BK or an SL, the license number, and then put your contact information in there so we can send you a copy of your certificate of the class. We're also going to send you this PowerPoint presentation. So for all of you guys, we're going to send you the PowerPoint presentation. You'll get a certificate. We're going to send you a link to this class, the 3-hour class that's on in the cloud, so you'll be able to watch it. And I'm also going to send you guys some articles. We have some step-by-step process, some articles that I've written for newspapers and magazines, which are kind of marketing stuff that you can use. I keep it on my computer and I just put it as like renovation docs. And then any customer that I pre-qualify, I always just send them this so that they have some reading material to know that there's a solution if we find a house that does need some work or maybe doesn't fit all their needs. So I kind of send it to every customer. Now, when I say that, I am about 60% renovation for the last 29 years. Now, I specifically go out and market for it. But of customers that I talk to, at best, I'm probably about 4 out of 10 that end up going renovation. Some of them do find a house that doesn't need it, or they do find a house that, it's enough where they can do it themselves or not a lot of cash. So I'm only 40%. So I don't expect any of you to all of a sudden start doing all your customers this way. But what it does do about renovation is it obviously makes that closing quicker because you can find a lot easier to find a house that does need work or that may not fit all their needs, but it works for them. But it's such a great alternative. Who would like to do another deal a month here on this class? Would you like to get one more sale a month? How much is that for many of you? It might be $3,000 a month. It might be $5,000 a month. We'll talk about later in this class about listings. I have an exact dialogue you should use when you're going to list homes that are older. We'll talk about that. So if you can get a sale and a listing every month, isn't that an extra 70, 80 grand, maybe even 100 grand, depending on your average sales price? That's all we're talking about. Get an extra deal. But the reason why I use renovation and why I talk to people about it, it increases the probability of closing. It makes the closing faster. I generally never lose a client because nobody's ever said, whoa, you sent me renovation stuff, so I don't want to work with you. That's never happened. But it's information to a buyer that I think most of them find useful. Like, wow, I didn't know that existed. Or I've seen all 35 of these real estate shows and nobody ever spent 2 minutes explaining how I was going to finance it. So apparently everybody's rich and has cash, when they're buying all these houses that Love It and Listed and Property Brothers and all that stuff, because they only go in certain markets. So they never explain how to finance it. So this is just kind of, I think, an important thing. Okay, so I said previously, somebody qualifies for 350 when rates jump up 1.25. That's approximately about $380 to $400 a month extra in the payment, which equates to about $75,000. So every 100,000 is about $500 a month, plus or minus, depending on where interest rates are. So if we increase mortgage payment because the interest rates went up, that $400 equates to 75 grand on qualifying. So somebody had asked over the break how that went from 350 to 275 is just simple math. If we're increasing their interest rate by 1.25 on $350,000, it's about $4 grand in interest. Divide that, 350 a month, and we get to that number. So those are ballparks. But somebody just asked about credit scores. So credit scores we'll go over here in a few minutes when we break down the 2 loan programs. Minimum credit score is supposed to be 580 on FHA 203K. Because of COVID, it's like 620 right now. for many lenders. So it just, all those things are slowly getting back to normal. When it first happened, everybody jumped to 700. They didn't want to touch a renovation loan unless it was a 700 credit score. Now that's back down to 620. Conventional has always been 620, and VA is generally about 640 or 660 when it's operable, because they want that to be just a little bit better client with a little better credit score, because we got to make sure that they can pay the bills. Okay, let's get to where we were. I think everybody can now see my screen. Thank you for being patient. So we left off there. So what's the most important reason I started this class? You can work on your business, or you can work in your business, or you can do both. And for most people, they spend their entire time working in their business and never work on their business. The problem is your business never grows unless you're working on it. And I'll use the dry cleaner example because many people just don't get that. If you have a dry cleaning business, there's one right across the street right here. And if he spent 40 hours a week or 60 hours a week or whatever that number is, if he did laundry and only pressed shirts, how would he ever grow his business? So yeah, he's making money on the shirts, but every single day his business is losing money and it's shrinking. Your business is shrinking if you're not working on a way to do it by attrition. Your current referral source, they will drop off, they'll get married, they don't buy, their family members meet other realtors. You're just in constant flux. So your business is growing or it's shrinking. Generally, there's nothing in between. So the only way to really work on your business is to make sure you have enough time. And time is the reason why I started this class. It's because I see the ones that are super successful and making a lot of money in real estate, and I see the people that are spinning their wheels and working really hard too. I want everybody to give me an answer. 1992, National Association of Realtors, they put out polls to buyers, to realtors or whatever. 1992, when I started, the first poll that shocked me, how long does it take to show a property to a customer? Everybody give me an answer. How long in 1992 did it take to show a customer a property? Now remember, no internet back then. Pagers, cell phones are just coming out to be affordable. My first one was 75 cents a minute. So they were super expensive. Got an hour, 20 minutes, 30 minutes, 45. There's somebody, 4. The number back then was 4 hours, 1992. And I want you to think about everything that's involved with showing a property. You've got to pull up on MLS, look for comps, talk to the customer over the phone, search through the MLS, contact the listing agent, coordinating a tenant that might need to get in or get out, dogs, pets, drive to the property, drive from the property, probably 30 or 40 minutes to show the property. You're probably all correct. Never more than an hour unless they're super, want the house and don't want to leave the house. But that number is 4 hours. Now, let's go flash forward to 2019, same poll last year. How long does it take to show a property today? Internet, cell phones and computers in your hands. Everything is much quicker. Customer can have a link of every new property. They can see them online, pictures. You can research all that stuff. How long does it take today? Four hours. Hasn't changed one bit in 29 years. Yes, there is technology, but do you still have to call the listing agent? Do you still have to coordinate the tenant? Do you still have to deal with the pet? Do you have to drive to and from the property? Is traffic worse today than it was 29 years ago? Does your buyer have too many choices? Can they access too much information? Does that make them freeze and want to see many things? Yes. Your buyers have different expectations today than they did when I bought my first house. Like many of you who are my age, I'm 53 years old. If you're close to me, I never saw what a nice house looked like until I saw it on TV. I grew up in a neighborhood. Everybody had the same houses. Nobody had granite countertops. Everybody had the same stuff. When I saw Dallas was probably the first time I saw a mansion. When I saw what was the thing? Lifestyles of the Rich and Famous is when we started to see this thing. Okay. And nobody really knew. So my expectation when I bought the first house, fairly simple. Does the roof leak? There's water in the basement when I bought it. Is there heat? Where am I going to park my car? Is there any water intrusion? How does the kitchen look? Simple stuff. We didn't have built-in closets. We didn't have any of that stuff growing up because it just didn't exist in my neighborhood. But that was my expectation. Today, those expectations are totally different. And the more information you give the customer, sometimes they get just too much shock. It's too much information. If you guys have kids, sometimes giving them too much information isn't a good thing. I went on the recommendation of the realtor that I worked with, who was a client of mine, somebody I work with, and somebody I trusted. And really between their recommendations and, the minimum standards I had for a house, pretty easy to find a house. And I wasn't super picky. Those things aren't the same anymore. Analysis paralysis. I love it, Kimberly. And it is overload. You're absolutely right. So if you're now, better question, and I want you to be honest, okay? I'm not going to send this answer. What's the most homes you've shown a customer? Everybody give me an answer. The most homes you've shown any customer, might have worked with them for a month, 6 months, 12 months. And I'm telling you, I worked with a client for 7 years that I just closed. So there's nothing to be embarrassed about it. But what's the most homes? Jason's got 50. Linda, 30. We got a 40 for Virginia, 35, 20, whatever. 35. Here we go, 21. 3, but I'm new. Okay. 22 in one day. Must have started at 4 a.m., finished at 4 a.m. Sharing is 9. Okay. Multiply 20, which many of you are much above that, times 4 hours. 80 hours. Half a month. 2 weeks of your life. Have you made $1 yet? No. Your number one goal after this class, your number one goal in this business is to show less homes. It's the only one. It's the most important goal. It's the only way that you can be working and sending out thank you cards and figuring out other ways to get business out of New York and figuring how to get in contact with other customers and posting in face groups and growing your business. To grow your business, you cannot show properties. You have to show as little amount as possible. Like I said, I bought 3 properties without ever walking in the door. I know the trick, and the trick is renovation. The trick is renovation loans. And the quicker that I introduce a client to that, the quicker that you do that, the less homes you're going to have to show them. I'll give you 2 different dialogues as well. You're the client before you ever took this class, before you ever thought about telling every client about it. Hey, I'm going to take you out. I'm going to find the perfect home in West Chase. West Chase, just a little west of here in city of Tampa. I'll find you the perfect home. It's the one you want. It's the one you've always wanted to live in, the one you see on TV or whatever. Can any realtor tell them that? Of course they can. Can any realtor pull up a listing? Sure they can. Is it going to be their perfect home? Maybe. Are you going to be one of 10 people writing a contract because it's newly renovated, new roof, new kitchen, new flooring, high-end best offer? You might be a 1 in 10 chance of even getting that house. I've got a different dialogue for you. I may find you the perfect home, but what I may do is also find you the perfect home for you. And it may not be the one that's all fixed up. It might be the one right around the corner that's the diamond in the rough. It might be the house that needs a new kitchen. Maybe it's 3,000 square feet, but it hasn't been updated since the Brady Bunch was on TV. But I'm going to help you find that perfect house and try to help you out with contractors and a lender that will help do that. Because what I do know is the houses that aren't perfect are the ones that are sometimes a deal. They're the ones that people are selling under market. They're the house right next door or right around the corner that might be a bigger lot, nicer property. You'll be able to put a pool, subdivide the lot, do whatever. But I'm going to help you find that house because that's what I do. Is I'm going to give you both options. We'll look at the ones that are perfect. But if it's something you consider on, maybe watch a couple of these shows. Let me show you a YouTube video, whatever. But if you're considering it, allow me to teach you how this program works. And I've never met anybody that was upset about learning about this program. So that goal is to take this from 20 to 15, maybe down to 10, to maybe 2 or 3. And like I told you, those are the deals. I've never made less than 50 grand, and I've made as much as $190,000 on the houses that I've sold. Personally, okay? Those are the 6 homes that I've owned, bought, fixed up using a renovation loan, and sold. The most was 190 3 years ago, right here in South Tampa. I bought a house on the corner of Sunset and West Shore. It was in 2010, right after the bank stuff. The roof was leaking, had water in the living room, had some septic issues going out to the street, lots of issues. 1959 house. Nobody would want to live in that house, but I bought it because my next door neighbor paid $650 for his house. The one across the street paid $1.2 million. I paid $286,000 for the house, and it needed about 30 or 40 grand just to make it livable. So these are programs that work, and it's a way to reduce the number of your homes. But that's all I want you to think about today. How do I show less homes? How do I get people closed quicker? And this is the answer. Okay, so let's go to the next slide. Here's some things that are happening from a market standpoint that you need to understand. Now, remember National Association of Realtors, Mortgage Bankers Association, they also poll people. And in 1992, when I first started, the average home buyer planned to live in a home for 7 years. That was a straight up number for about 2 decades. And that's how they first started with adjustable rates and balloon mortgages. So in the mid 90s, when they started doing what's called a 723 balloon. So rates were just coming from 10 down to 9s and 8s. And they figured out a way that they could offer somebody a lower interest rate by doing a 7-year balloon. It was called a Fannie Mae 723 balloon. The loan was amortized over 30 years, and they had 7 years to balloon payment. So it would give them a point difference, a lower rate. And that was the average time a person was going to live in a home. So nobody really ever stayed in a loan after 7 years, to be honest. So it was a good fit, a good program. And then they started switching those to ARMs because balloons can be dangerous. We're going to flash forward for any of you guys who were in the business in 2000 to 2005. And it was much like it is today. It was crazy. Values were going up. Things were happening. The difference is that it wasn't real. So for those of you who heard or lived through the bubble in 2000 to 2005, it was not a real run up. It was a fake run up. And what had happened in the 90s is everybody had the dot-com boom. So people would put $3 grand in the stock and make 20. They'd take $10,000 and put it in Microsoft and make $1 million. There were some really things going on. Somebody mentions The Big Short is exactly how it happened. This was speculation. It was fueled by my industry, by the mortgage industry and the banking industry, who created mortgage products for people who had no business buying houses. We had no income loans, we had no doc loans, we had no housing loans, no credit score loans, no income, no job, 0 down. My favorite was a guy came into my office literally from Bear Stearns, from that movie. And I had 3 mortgage offices at the time. And the guy says, I have 100%, no income verification, interest only, investor loan. And I made him repeat that to my partner and told him he was buying me out, that I wasn't going to do any of these kind of loans. So those are the things, we kind of saw those things. And that was back in 05 before any of it happened. I knew it was going to happen because I knew people that were buying. I knew people that had 4 and 5 contracts on properties that never could make the first payment. You're not doing them a favor by doing that. But during that time from 2000 to 2005, the difference is today is real. Businesses are doing well. People are making more money. Our median income went up 5% last year. Gross revenues to the United States Treasury went up this year, even though COVID. Okay, people are making more money. There's more profit. Now, even if things weren't doing great, people are still relocating to areas where it's great. So Florida will be insulated. Even if there was a downturn, we won't feel it for a decade. So things are going to continue to get better. But in 2005, the average homeowner was only going to live in a property for 3 years because their expectation was, if I buy this house for 200, what's it going to be worth 3 years from now? Is it going to be 250? It's going to be 300. And they didn't plan for the repairs. Now, houses have always depreciated. They've always need roofs. They always need kitchens. They always need air conditioning. But the customer was like, listen, I'm going to buy it today at 200,000. I can get insurance, kitchen, but in 3 years, I'll do a cash out refinance. I'll go get an equity line to do the repairs. Or if it goes to 300, I'm going to sell it. Why would I fix up a house that I can make 100 grand on? So those are the expectations back in '05. So nobody did renovation loans back then. Nobody planned on living in a home for a different time period. Today, that is completely different. Today, the average home buyer thinks that they're going to live in a property for 12 years. This is the longest period in US history for a customer to think that they're going to live in a property for 12 years. Now, much of that your client will never tell you. I may never know because it probably happened over 7 years ago. When we do a credit report on somebody, we can only see late payments for 7 years. We can see bankruptcies and foreclosures for 10 years on their credit. So if they did that in 2007, 2008, 2009, I would never know that they had any of those life-changing events happen to them. There were millions of people who did short sales and foreclosures and deeds in lieu of foreclosures and had to do, offers in compromise and all kinds of stuff that happened. And they went through financial difficulty when all the banks, because it wasn't just the banks that collapsed, it was businesses, it was money, median income went down, all those things, people lost their jobs. So they think differently today. When you have a customer that's looking at a house for 12 years, it's not just about stainless steel appliances anymore. They want to talk about the roof. They want to know when the air conditioner is going to go out. Yeah, it looks new, but doesn't everything that's in the last 10 years kind of look new? Is the air conditioner going out next year? Is that a $5,000 fix? They want to know about the plumbing. They want to know about the drains. They want to know about the sewer and the septic system. And they may not even tell you that they had financial difficulties in the past. So it's just important for you to know that 12 years is a big deal. It's the largest it's ever been. And customers are asking about that. They're asking their lenders. They're asking you guys, hey, how long is this roof? How much is this roof going to be cost? So people are thinking long term. Now, that's a good thing. I think it's a good thing for any family to begin with that end in mind. You have a 7-year-old child. I got college in 7 years. You have a roof that needs to be replaced in 5 years. Where's that going to come from? So those are the expectations in the market that has shifted. And look at Helen, 17, 18%. So Helen is mentioning the interest rates and how good they are today, obviously. I started in when they were just getting below 10%. Helen, 1979, I believe, 1980, 19% for an FHA loan and 6 points was how much it costs. So when people tell you the rates are bad, they're crazy. The other things that have happened is expectations and technology. Your client has higher expectations today. They want to see the walk-in closets. They want to see the quartz countertops. They see them on TV. They want to have them. So those are the things that have really changed hands. Like I said, we didn't have walk-in closets when I was a kid. We didn't have closet systems, big bedrooms, small closets, kitchens that were obsolete. Those were the normal things. So expectations have changed quite a bit. So what's going on with renovation loans? Why are we here in this class? Renovation loans have rocketed. They are not a new program. They've been around since 1978. So when FHA, prior to FHA getting involved in creating an act, most people had to put 20% down when they bought a home. So they put their 20% down, and it was keeping people from really owning a home. So in 1978, FHA came up, was enacted. It was both FHA 203B, which is a regular FHA loan, and 203K. HUD understood if we're going to let people do 2.25% down, we better darn well have a solution for them as the house gets older. So they were smart enough to enact the 203K program as well, because they knew these houses were going to need roofs. They were going to need flooring. They were going to need air conditioner and heating systems. They knew that from day one. So 203K has been around since 1978. It is not a new program. It rocketed in popularity until about 2002, when there was about 60,000 renovation loans in the whole country. And that really tailed off, as we talked about for the no income, no asset loans, because what was happening with those loans is they were doing limited appraisals or desk review of appraisal. My favorite in 2005 was they had what's called a drive-by appraisal, and never knew if that was a speed limit. Is that 50 miles an hour? Is that 10 miles an hour? No idea how you do an appraisal by driving by a house, but they were letting it happen. So they got down to the lowest point they ever were in 2006 with only 2,000 renovation loans. When we fast forward to 2019, there were over 200,000 renovation loans last year, over 200,000. That's expecting to approach 2 million within the next 3 to 4 to 5 years. Because what's happened is a couple of things. One is that lenders have become better at it. We have more people that are involved in it. We have more lenders, more underwriting departments that are participating. We have entire lenders that have whole divisions now that do renovation draws. People have learned about the program through TV. To be honest with you, the 35 shows that you see has created popularity among people fixing up homes. And because there's more people in it and more people doing it and people are getting better at it, the pricing has gone down. My first 203K in 1993, I got 9.5% when everybody else was getting 8%. So I took about 1.5 points higher in interest rate to get this renovation loan. Was it worth it? Darn right. I had $130,000 worth of equity. I got a home I could never afford. I lived in a nicer neighborhood that I could ever imagine by using a renovation loan. All of that was worth 1.5 points. Do you know what the difference in the rates are today? 0.25%, 1/4. So if regular rates are at 3.25%, the renovation loan is at 3.5%. There is no reason that any customer should not want to do a renovation loan. It's a pizza every month is the difference, literally. So the rates have come down. They're almost the same as regular conforming rates. And lenders on my end have realized that they're the lowest risk loan that they ever do. Yes, they have to wait for the construction to get done. Yes, we have to hold it on our books and have a draw department, but they're the lowest default ratio times 5 of any other loan. A normal loan is about 1% default ratio. It's 0.2% on a renovation loan because these clients are fixing up their roofs, they're fixing up their homes, they stay there longer, they have pride in ownership, and the home is worth more money when they fix it up, right? So if they put 50 or 60 grand in it, it might appraise for 100 or 150 higher. Now they have the equity to sell when they want to sell. Now they have this equity to sell and make money if they want to do it. So the popularity of renovation loans is through the roof. My phone in 29 years has never been busier. In fact, we had to hire multiple people just to help. So I believe those all to be a good things. And I think that that will help you moving forward. So what changed over that time period? Regular conventional loans were 20% down. Now we're at FHA 2.25. Now we're up to about 3.5% down payment. Program started in 1978. Fannie Mae Homestyle is about 10 years old. So Fannie Mae first started with what's called Fannie Mae Home Path, where they allowed customers to buy houses with 35 grand worth of repairs. And then Fannie Mae Homestyle has now surpassed 203K because it allows a conventional buyer 3% down, 5% down, 10% down for second home, and investors. So the Fannie Mae Homestyle is this huge umbrella of renovation now, and it's much bigger than FHA 203K. And somebody mentioned the MLS book. I physically remember that book and seeing realtors page through it. Okay, so FHA, Fannie Mae Homestyle, VA is the new kid on the block. VA renovations only been about 4 or 5 years. I only started them about a year and a half ago, maybe 19, 20 months. And I got to close about 6 of them before the program was shut down by VA, hopefully as a temporary basis. But VA was the new kid on the block. They were only allowing 35 grand worth of repairs. But more importantly, VA was allowing veterans to buy a home and fix it up. And I hope this comes back very quickly. If you guys work with VA buyers, you know, sometimes they don't get the house that they want. And that's because the VA inspection is a little tougher than FHA. It's a little bit tougher than conventional. And some sellers have a misrepresentation that VA is super, super tough. It's very reasonable. In fact, the last house I sold had wood rot. There had a little section of the roof that needed to be replaced. VA closed it no problem. So it's not the end all be all, and not all VA appraisers are super picky. So first of all, I wouldn't get scared about that and get rid of that misrepresentation. And it's common sense stuff. VA, does the roof leak? Is there some rotted wood that needs to be repaired? Do the appliances work? So the veteran has a range and a refrigerator that works. This is a little simple stuff. Other than that, it's pretty much just a regular FHA inspection and conventional. And many people have a misconception that conventional means, oh, all wheels are off. Absolutely not. I've seen conventional appraisals that need wood rot repair, holes in the wall, little cosmetic things that you would think need to be done. They're making them do it on conventional loans. So the old wives' tale that FHA and VA are so much harder on inspections is just not true. Now, FHA requires peeling paint to be dealt with, but that's kind of a smart thing too, because that's water intrusion, that's termites, that's wood rot, it's fungus, it's all that stuff. So those are just common sense things. So let's get rid of those misrepresentations that it's just not accurate. And like I tell you, on conventional loans, I get roof conditions all the time. We see wood rot, broken windows that need to be fixed. It's all just common sense stuff. Okay. VA would require termite treatment for the property before they approve the loan. So VA, so we live in Florida, so FHA does not require a termite inspection, actually. The only time FHA requires a termite is if an appraiser says, I see termite damage, you should go get it inspected. VA requires a termite inspection for every borrower, every place, everywhere, every time. The seller must pay for the inspection. And those things on VA have to be resolved before closing. So you'll get a loan approval, you'll get an appraisal, but they'll have to do the VA repairs and treatment before closing. That's just how VA works. VA renovation, FHA, and Fannie Mae, that house could be termite destroyed, needs to be tented, all that. We close as is. You do the termite after closing and all the treatments. So that's the best part about renovation. But so VA is the only one who actually requires a termite inspection unless a VA appraiser or somebody sees damage. Okay, so how does this process work? So what we're doing in a renovation loan is we're taking a purchase price like you normally would do it. You're going to take your customers out, you're going to find the houses that are in the neighborhood, and let's say all the houses in the neighborhood are 220. They're 3-bedroom, 2-bath houses. You find one that's listed for 150, looks like it needs a roof, needs a kitchen, needs flooring. Let's say it's in disrepair. You're going to write the offer on the contract like you normally would write on any other offer on what you think the as-is value is. Not really relevant what the repairs are per se, other than what is that house worth today as is. The next step we're going to do is we're going to bring in a 203K consultant. Now that 203K consultant is a licensed home inspector. They're certified by HUD, and they are trained to look for the items that lenders will require. Now, we're not going to test the polarity of every electrical outlet. We're not going to go in and turn things on and make sure the AC gets to a certain temperature. It's more pass fail. So does the heat work? Does the air conditioner work? Any items that we see that are safety issues, we want to make sure there's smoke detectors in the house. We want to make sure that anything that would function that's going to limit the sellability of the house. Are there holes in the flooring? Is the carpet so worn that it just can't be used anymore? Does the kitchen need to be upgraded? Any electrical panel issues? So they're going to give you what they call minimum property standards. So these are the things that need to be identified, that need to be fixed to get financing. If you've ever seen an appraisal, it's called C4 or C5 condition. That's where the house is unfinanceable in its current condition and needs something fixed. So like our leaking roof is C4 automatically. Electrical panel that's been removed, C4, because it can't be lived in. Air conditioner has been stolen out of the backyard, that's C4. So those are the conditions that will prevent financing. And to be honest, they're the most important things to know, because it's important to know what the lender's going to think. A home inspector's opinion is their opinion. You, myself, my 10-year-old son can walk around a house and see, hey, those windows are broken or those things. These are the important things that need to get done to get a loan approved. So the good thing is when this inspector comes out, it's not just a home inspector saying what needs to be fixed. This is what HUD says and Fannie Mae and VA say need to be fixed for any client to get financing. That's the best part about these 203K inspectors. And Lauren had asked, we're going to send you a list of all the 203K inspectors in the state. You can also always go to HUD.gov and type in 203K consultants, and then type in the county, the zip code, the city. Any of those items will get you right to the 203K consultants. We're going to send you a list of all of them for the whole state so that you have a copy. Now, these are the best of the best, to be honest with you. Most 203K consultants have many years of experience. They're home inspectors. They come from a construction background. The difference is when we get this 203K inspection report, it's in a specified 35 line item checklist. They're looking at foundation, framing, roofing, plumbing, all that. But they're going to give you the list of everything that needs to be repaired, and they're going to give you a ballpark price of how much it's going to cost. I'm going to ask a question real quick. Who in here uses a home inspector or many home inspectors, and they get a list of everything that needs to get fixed, and they don't give you prices? So who gets a list and it doesn't give you any prices on how much it's going to cost to fix it? Every time somebody's laughing out loud. Does any home inspector ever tell you, please consult a licensed roofer? Please consult a licensed electrician to look at this panel. Or, boy, you need to speak to a foundation inspector. Looks like all of you have the same answer. Why do we use home inspectors in the first 15 days of a contract then? If they have to refer you to somebody else and you don't know how much it's going to cost, what's the point? 203K inspectors, I like to use them on any deal. Even if I'm going regular FHA or regular conventional, I like to use a 203K consultant for the inspection with the permission of the realtor, because now I know 3 or 5 days into a contract what's going to pass for FHA, what's going to fail. And in our business, the 203K consultant is the decision maker. They are at the property. They are licensed home inspectors. They are construction estimating experts. And the appraiser and the underwriter both listen to the 203K consultant. If he says the roof is good, the roof is good. He says the roof needs to be replaced, the roof needs to be replaced. He's going to give you a list of everything that's going to be needed and a ballpark cost of how much it's going to cost. This is the best negotiating tool you will ever use in real estate, because it's not just a home inspector, it's HUD. It's Fannie Mae, it's VA, it's telling you, these are the things. I'd hand it to the seller. Here are the 5 things that this house failed. Nobody can get financing unless they fix these 5 things, and this is how much it's cost. I've seen every single contract renegotiated when these things are presented to a seller. I've seen Fannie Mae, FHA, bank-owned properties renegotiated by 203K home inspection reports. It's the best tool in real estate. So we're going to refer you to some people. If you have a great home inspector, they can become a 203K consultant. They also go to HUD.gov, click through the steps of how to become a consultant. It takes about 6 months. But boy, when we go through this, you'll see what a great deal it is for the inspectors as well. A 203K consultant is $400 to $600 on the initial inspection. Now if they're $400, it's just the initial inspection, which is very similar to a regular home inspection. They're usually $350 or $400. The ones that charge $600 include their initial work write-up and all the costs in that $600. Now they pay that out of pocket. If they pay with a check, we can actually roll that back into the loan amount as a fee of the cost. Whereas a normal home inspection, you don't get to roll that into your loan at all. But those are the initial fees. Now the 203K consultant also makes 1% of the total repair. So if it's $50,000 worth of repairs, they're going to make another $500. That is rolled into the loan, and the customer never pays it out of pocket, because this 203K consultant is not only going to be there for the initial inspection, they're going to get all the bids from the contractor and the customer. They're going to coordinate any questions, answers, put it in the format of the Fannie Mae draws. They're the same guys who are going to come out and do the inspections. They're going to release the money. They're going to take pictures. They're checking in to make sure all permits are closed out. They're going to help with the final title work. They're going to be cutting all the checks. They're there from the initial inspection until your client has done all the rehab. That could be a year that they're on that project. But isn't that a good thing for you and your client? You've got somebody who's a construction expert that's involved in the entire process from start to finish. Because for most people, they don't ever do home repairs. But the consultant is there not just for the initial inspection, they are the go-to liaison referee for the entire project. And yes, this can be in lieu of a typical home inspection. If you want to do your own home inspection, certainly welcome to do it. Most customers don't like to pay for it twice. So totally you can leave it up to the customer to do that. Okay. And generally, to be honest, they're not as busy as other inspectors. They take less jobs because they get paid for the initial inspection, they get paid for the draws, and they get paid 1%. So a good 203K inspector might have a very small regular inspection business, and they do a ton of 203K. So great question. They're usually very available, to be honest with you, because they make more money on a deal instead of just the $400. With some projects that are $250,000 renovations, and they make another $1,500. So they cap it at $1,500. Never seen that fee be over $1,500, but they make an extra $1,500 plus they're getting paid for the draws. It's a very profitable thing for inspectors. So they only have to have 8 or 10 projects going a month, and they make a pretty good living. So it's a really good program for them as well. Okay, for standard industry costs. Those inspections are standard industry costs. HUD doesn't actually regulate that. They set guidelines. So some consultants might charge a little extra. Any of you guys that are in the panhandle, they have to charge mileage if it's a really far deal. I have a deal going in Sebring. I think we have a realtor here in from Sebring today. And they might charge a little more because they're coming from Naples or coming from a different area. So they will charge mileage if they have to, if it's a really long commute. But that's a good thing. And we know we've got a professional that's coming out, going to take the job seriously and doing a real good job. Okay, so what happens? We've got that 203K inspection. And now what happens is the contractor will be handed that report. Now your contractor can be there at the same time as the inspection. And if you're doing simple, quick stuff, and that's available, go ahead and do it. But we want to hand that inspection report to the contractor. Now, the contractor is not obligated to any of the numbers the consultant came up with. Contractor gives his own numbers, okay? Those could be higher, they could be lower. And we use the contractor your client picks. So it's always the customer's choice. They can use the least expensive guy, they can use the most expensive guy, they can use the one that's in between. So your client picks whoever they want to use, and we're going to use their numbers exactly. So those numbers are sent to the consultant. We come together with a final SOR called a schedule of repairs. We come together with a final estimate from the contractor. All 3 parties are going to sign this estimate. Homeowner, contractor, 203K consultant. Everybody has signed and agreed. This is the scope of work that we're going to do moving forward. Now that's important as a lender because this is what we're sending to the appraiser. We send them the inspection report. We send them the scope of repairs, and we send them your purchase agreement, and they're going to do all the appraisals on what the after improved value is. Now, we don't just lend them 50 grand. We're going to lend them 10% on top of that. It's called a contingency reserve. So we're not doing construction. We're doing reconstruction. What are we going to find when we tear the roof off? Rotted wood, missing insulation, electrical wires that might have been chewed by a rodent. We might find rodents. We might find rafter tails that have some termite damage that need to be shored up. We're opening up drywall. We might find some plumbing or wiring that needs to be addressed. We will always have a minimum of 10% contingency in every deal. If they don't have electric or water, we're going to bump that up to 15% automatically. If it is a major renovation or a safety issue, we're doing a second story. We're doing a garage addition. We're doing asbestos ceiling tile abatement, or maybe some asbestos shingle abatement. We're going to put in 20%. This is extra money we're lending them. It is not out of pocket. It's money that sits there in a side account called contingency reserve. It's what we use for cost overruns because we don't want a client to run out of money. We want an inspector estimating. We want a GC who's licensed and experienced. We want a lender who knows how to do these, an underwriter, an appraiser to look at it. We would rather give them too much money than not enough because we don't know where the money's going to come from if we run out. So if they don't spend all the money, it is a principal reduction to the loan. So if they don't spend 55 grand in this instance, the 5 grand would be a principal reduction to the loan. So the money doesn't go back to the client, it just goes to pay down the loan. So that's why I say we always want contractors to estimate a little bit high, include the things you think you're going to need, and then tap into contingency on top of that if you need it. So when we're doing the appraisal, we're looking for the after improved value. We hope this house is going to appraise for 205. Doesn't on a 203K, it has to approve for 10 or appraise for 10% less than that. And this is how we calculate the down payment. Calculation of down payment is sales price plus total repair escrow times 3.5%. So look how cool this is. Buying a house for 150, they borrow 50 grand to fix it up. They need 71.75 down payment. Is that cool? I think it's awesome. The customer can have the seller pay all the closing costs like a normal conventional or FHA loan. They can pay within those limits. Your client can literally walk in for $7,200 to buy this whole property and get 50 grand to fix it up. Kind of awesome. And the conventional version works the same way. The client gets 5 draws as needed. So the work does not start until after your customer owns the home. We close as is. So the money is closed. Seller gets paid, you get paid. The repair escrow sits with the lender, and the contractor takes draws as they complete the work. So this is a super safe loan program because the work is done and then the check is cut. So there's never going to be a scenario where we're behind in that situation. The checks come in a joint check. So the consultant comes out, they take pictures, they do a draw request, contractor and homeowner both sign agreeing. Then we send a check payable to the contractor, the homeowner, and the homeowner has to take that next step and sign it over. So your homeowner is as protected as God's green earth. They are not going to be, they don't like the work, they don't sign the check, they don't sign the draw. We force the contractor to do the work to a workmanlike manner. Like we said, contingency is there extra to be used. Let me see if we have any questions here. Wind mitigation and WDO, those are different inspections, and those are insurance inspections. Some 203K inspectors do them, some don't. To my experience, about half and half. So some of them are able to do wind mitigation inspections. They will charge extra because those are different, and it's a different person. So those are certified to the insurance carrier, and it is a totally different inspection. So it's about half and half that I see. And also super important, if you think that you're going to have an insurance issue, and this is every customer, whether it's renovation or not, the first thing out of the box, get insurance estimate within the first day of writing a contract. You tell your customer, go get insurance quotes. You can look up on FEMA. It's called FEMA Maps. Click in Google FEMA Maps. You can type in the property address and you will see if that property is located in a flood zone. That's the first thing you want to know because you want to get homeowners insurance quotes immediately, find out if a 4-point inspection is necessary, and you want to see if it's in a flood zone because that controls everything. If that flood insurance is $400 a month, you may not have a deal. So those are the first thing you want to do in any contract, whether it's renovation or just a regular purchase. We do that on our end from a mortgage company standpoint. Highly suggest you guys do it too, because it's just going to make you a better at what you do. And then FEMA also controls how much repairs you can do. If you have a $200,000 house, you may not be able to do $100,000 worth of repairs if it's in a flood zone. So these are things that we need to address kind of right up front. Repairs have to start within 30 days of closing. And for 203K, they have to be completed within 6 months. If you're doing a major renovation loan, that can get extended to 9 months. and Fannie Mae will allow you up to a year to do major renovations, like if you're doing a second story, adding square footage, that type of thing. So you have up to a year to do that. 203K goal is 6 months, 9 months on an extension. And generally they always happen. They're facts. Max loan amount, we're going to go in after the break. Any questions you guys have before we take a quick break? We're going to take another 10-minute break. So it's 11:14. Let's call it 11:15. We'll come back in here 11:25. You guys put questions on the chat, and I'm going to leave this slide up. Any questions you might have, and we'll answer them right when we get back. So everybody take a 10-minute break. Hey guys, we're going to get started here in about 2 or 3 minutes. So everybody, the last, let's say 40 minutes of this class, we're going to get through a lot of material, and I'm just looking at some of the questions. If you guys have questions, please fire them through chat, and I will start this next session by answering some of these because they're great questions. Okay, 2-minute countdown. We'll get started here in 2 minutes. For those of you that are listening on the class now, while we're waiting at the break, please make sure that you have registered for the class. AJ is putting a link up on there. So if you scroll through the chat and see AJ will put a link, make sure that you have registered for the class. Need your first and last name as it appears on your license, BK or SL, your license number, and then your contact information. And we will get you not only the certificate within the next couple of days, we will get you the link for this class, which is a 3-hour class. We're going to get you some articles, which are about the program and how they work. We're going to get you step-by-step process, eligible improvements. We'll be going over these things over the next 40 minutes, but we'll get all these things out to you. Our goal is to try to have some information you could just keep on your computer. I keep it up in a corner on my computer, and I click it and drag it every time I send somebody a pre-approval or they send for an application. I do the same thing too. Hey, here's some good reading material. We also have a YouTube channel, which is available that you can look at. You can check out our website as well if you ever have any questions. And then if whether Candace invited you, Jason, AJ, if you're working with those guys and they invited you, you can always call them and they'll be able to answer any questions here, as well as if I invited you, you can call me as well. Kind of how we work here is that I handle all the renovation stuff and questions. So I'd be glad to help with anybody. You guys are going to have questions. This is honestly, it's a 3-hour class. We could spend 30 on how to grow your business and all that and how the program works. We'll try to get as much material as we can, but you're going to have questions. I do recommend that you come up with a team, come up with people that you trust and contractor that you like and interview them. Contractors are a great source of business for you, not the other way around. Once you start sending a contractor business, that guy knows people who are buying houses all the time. They'll call him, hey, what do you think? How much is a kitchen? That kind of thing. And sometimes, to be honest, contractors refer us more than we refer them because they're out there doing deals, purchase. Their buddy has somebody who's buying a house and needs work. So I would say most of the contractors we work with probably send us as many clients, if not more, that we send them back. And it's just a good partnership. All right, so let's go back in here to the questions. So please make sure everybody signed up. Okay, so we talked about 203K inspectors, wind mitigation. The contractor can be related to the buyer only in Fannie Mae. So on VA and FHA 203K, it is actually by law, they cannot have any affiliation. So they can't work with the contractor. They can't work for the contractor. They can't be related to the contractor. 203K has a very special rule because of all the fraud in the 90s. You can't even be the realtor and related to the buyer on a 203K. You must use your broker or somebody else to be the realtor. So for your relatives, they do not let relatives do anything. So you can't be related to the consultant, the contractor, the realtor, or the mortgage person. None of these people can be related to each other. During the 90s, it was the biggest fraud ever, and they milked HUD out of just millions and millions of dollars. So nobody's allowed to be related. It has to be an arm's length transaction for FHA 203K. Fannie Mae, it has to be just arm's length. So if your client is the contractor, they can use their buddy. If they work for the contractor, they can use their boss to be the contractor. You can be related. It can be husband and wife. All that's okay for Fannie Mae. They don't really care, but FHA has a big problem with that. And by experience, they got hammered by it. So there's a reason for it. So refinance and purchases are both available for both programs. What's good about the refinance is that they already own the property. The rule is, and you want to write this down, it must be an existing property for at least 1 year. So if it's new construction, you can do a Fannie Mae Homestyle immediately after you get your certificate of occupancy. So you could do a pool renovation and do a pool loan. You could do a room addition. Must be have their certificate of occupancy. For FHA, that must be expired 1 year. So the house must be at least a year old, and that's the only rule. Can you tear down a house and build a new one? Yes, as long as you keep the foundation or one wall. So you can tear a house down, leave one wall standing or the foundation, and build a new house. You cannot raise the entire property. So if you bulldoze the whole renovation and the whole foundation, it's no longer a renovation, it's new construction. New construction's 25% down, very tough to qualify, generally 2 closings. Call it the top 1% of people are the only people who can afford construction perm loans. So because you got to qualify for the old house, the new house, the construction perm, just very difficult to qualify for construction perm. So renovation makes it easy, but you've got to keep the existing foundation or one wall standing. So great question there. Refinances and purchases are the same interest rate for 203K. For Fannie Mae, there's an extra 0.5 point. So Fannie Mae instituted a refinance fee of 0.5%. That's their fee. That's the only difference between the rates, is that 0.5 point fee on a refinance for Fannie Mae. Let's see. When does the mortgage loan originator and the realtor both get paid, and the seller all get paid at closing? And then after that, it's between the contractor, the inspector, and the home buyer. Everybody else is out of the game at that point, and it's ready to go. Conventional route. So the good thing about a conventional Fannie Mae Homestyle, as we talked about, we have 3 different ownership types. We have primary residence. Actually, we have 4. Primary first-time home buyer gets 3% down. Primary 5% down, normal if they've owned a home before. Second home for 10% down. And then investor, the minimum is 15% down. However, nobody could ever afford it anymore. So you really got to do 25% down as an investor. So and remember, it's on acquisition cost or appraisal, whichever is lower. So usually these things over appraise is the reality, but we use acquisition cost. So your down payment is purchase price plus repairs, and that's your total acquisition. And then we do your down payment based on that. If you put 20% down, there's no PMI on a conventional Fannie Mae. If you put 10% down, the PMI is reduced. If you put 15% down, it's lower. 5%, it's different. So the PMI is the big difference. For people who have really good credit scores and money to put down, we always take them Fannie Mae Homestyle. FHA is more lenient on debt to income ratios, lower down payment, and a little lower credit score. So that's really the only difference between them. Contractors do not need to be certified 203K. We will individually approve contractors if they are licensed, if they have insurance, if they have workman's comp. They fill out a resume, and we will approve them individually. Florida is the toughest state in the country to get a contractor's license. So as long as there isn't a warrant out for their arrest or they have lots of fraud claims or whatever, we're probably going to approve them. Now, your contractor has to have the financial wherewithal to be able to work on draws. Not every one of them do. Some smaller contractors need cash up front. For 203K, there is no cash up front. They do the work, call in for an inspection, get paid. They have to have the ability to do that. Fannie Mae Homestyle will give them a materials draw, half of the materials draw upfront at closing. So we will give them money to get started on ordering cabinets and flooring and all that stuff, only on Fannie Mae. FHA has no advances are allowed. So your contractor has to be financially savvy. They have to have their own good credit to pay, get materials, and then get reimbursed. So that's the important thing to know. The contractor must start within 30 days, finish within 180 days. Talked about it, certified. Max loan amount. So you guys are in all different areas of the state. Fannie Mae Homestyle, the max loan amount is $548,000, which is the normal conforming amount. FHA is different for each county. So I think there are 1 or 2 of you are down in the Keys and Naples. area, you have a different FHA loan amount for your county. So that might be 400, I think down to the Keys, it even goes up to 600,000 for FHA. Miami, 450 in certain counties, 425 in others. There's a few of you that are in Jacksonville and you're up in the 400s. For Tampa, I think it's 356 right now, and that's adjusted every year. So every year, FHA will determine by the county what the median sales price is, and that's for a 1-unit property. So if you have 2 units, the loan amounts go up for 2 and 3 and 4 units as well. Okay, go down. Here's some other questions. So PID. You make your payments. Okay, so when you close, your first payment is due. You close May 15th. Your first payment is going to be due July 1st by definition. You immediately start making your mortgage payments from that first July 1st. Most repairs on a renovation are going to be done in the first 30 to 45 days because most renovations are somewhat cosmetic. Their roof, their electrical, their plumbing. Almost all those repairs are going to be done in the first 30 to 45 days. It should only take longer than that as if you're ordering custom countertops. Maybe you're adding square footage or a bathroom where you're going to need plumbing and electrical rough-in inspections, that type of thing. So you've got automatically built in 30 to 45 days into the deal. Now, what's important that I want you to write down is if you need to go past that, you can finance 1 to 6 payments into your loan on FHA and Fannie Mae Homestyle. So if you have to be out of your house while we're doing a second story, you can finance 3, 4, 5, 6 months of payments. Now, it's not free. We're putting it into your loan, but it allows you to have no mortgage payments so you can pay rent while you're fixing up this home. So it's a very nice, flexible feature. Some people only need 1 payment. I've used it a couple times where I've done the full 6 payments because I took a 2-bedroom house and turned it into a 4-bedroom house. And I certainly wasn't going to live there. That was the second home I ever did 203K. So we allow you to finance the mortgage payments. The contingency is 10% audit to the loan amount and not a down payment paid at closing. Correct. The 10% contingency or 15% or 20% contingency is on the renovation amount, not the entire amount. And it is financed to them 100%. They do not have to have any money out of pocket. We lend them the contingency because we don't want them to have to come up with another $5 grand or 10 grand or whatever. It's all lent to them. We'd rather give them more than enough money than not enough money. So great question. Let's see who else has got that. Yeah, so somebody said Collier is now 460 for FHA. Conventional are the same. We all have the same conventional. And 4 units go up to $1 million, which is awesome. So is it more complicated? This is the last question, then we'll get into these last couple slides. This loan is the easiest loan I ever do. A renovation loan is very easy if you know the steps and if you take the time to learn the process. For me, as a renovation loan, I'd rather do a renovation loan than any loan on the planet because you know what's hard is you have a $280,000 FHA purchase and it underappraises by $5 grand and you've got some wood rot and some peeling paint and a couple things that need to get fixed. What's going to happen next? First of all, you don't find out about it until on a 30-day contract. You find out about it 7 days before closing, and now it's not closing on time. So everybody's upset. Listing agent, selling agent, seller, buyer. The wheels just came off. Now this happens on every FHA deal on an older home. Then you and the listing agent are going to argue about what an as-is contract is. Yes, it's an as-is contract, but the reality is the house has to meet minimum property standards. So you're at a stalemate. Their financing is contingent upon the house being in financeable condition, and the seller wants to get paid and get their money. So you guys will argue for a week about what's what. Then you got to go out, you got to find somebody to get it fixed. The seller and the buyer, seller wants to do it for the cheapest amount possible. Your buyer wants it done correctly and doesn't want it to look like a 10-year-old did it. So that's going to be an argument in yourself. And then is it warranty? Did a licensed contractor do it? It's a hassle. When I have a 203K and something pops up that needs to be fixed, all I do is add it to the bid. I've closed renovation loans in 18 days from contract to closing because they're easier. Anything pops up, we just put it in the contractor bid. So if a toilet stops working, a window's broken, the appraiser catches something else, we go back to the contractor, hey, put this in your bid, we close the loan. They're actually easier to close than any other loan possible. They're easier to close because they're 10% wiggle room on the appraisal. So if we've got a tight appraisal and houses have done, I've had people switch from FHA to 203K so they could get a contract and not have the appraisal contingency in there, or at least a 10% wiggle room. So they're just easier, is the possibility. And there's no income requirements. At 203K, Fannie Mae Homestyle, they're the same guidelines as every other loan. So if they qualify for FHA, they're going to qualify for 203K. If your client qualifies for VA, they're going to qualify for VA renovation. And if you're qualified for a conventional loan, you're going to qualify for a Fannie Mae Homestyle. No special exceptions, no income requirements, no anything. So they're just done correctly. All right. And then we'll get back to these questions here in a minute. Okay, eligible properties, all single family detached are eligible. So any home that's single family is going to be eligible. Any home that's in a PUD, which is a planned unit development, mandatory homeowners association, is going to be eligible for both FHA and Fannie Mae Homestyle. Caveat, you do a room addition, you do a structure or anything on the exterior, remember you've got to get HOA approval. And it's the first thing you got to do. So if you're going to do a pool enclosure, you're going to add a pool, room addition, change the exterior of the house, HOA controls that. So that is your first call on anything. Contractor will get some plans drawn up. You'll submit them to the HOA. Now that doesn't happen overnight. Sometimes they meet once a month. Sometimes they meet every 2 weeks. So if you're going to do, let's say, a refi, or you're going to do a purchase and you want to put all this in, you might need a little bit of an extended contract so you can get approval for the HOA. We require it because we're not going to let you finance a pool where the HOA doesn't let you put a pool in. So that's the one thing I want you to do. And we'll get to these questions here at the end. Single family attached, any townhome is going to be eligible. Any villa is going to be eligible as long as it is a fee simple villa or townhome. Condominiums are only Fannie Mae. So what's been happening over the last decade is FHA and VA are getting out of the condo business. Fannie Mae has gotten significantly better at the condo business. So condominiums have to go Fannie Mae Homestyle. Simple stuff. Generally a condominium, you control your walls in. So you can do drywall, flooring, countertops. If you own your air conditioner, you can do it. Generally the exterior of the property, the doors, the windows, the porches, that kind of thing are controlled by the HOA. So we're not going to let you do them. But that's case by case basis. We had a condo last year, had a deck. Condominium assigned the ownership of the deck to each unit because they didn't want to spend 15 grand per deck. So just never know. But the condominium has to allow you to make those repairs. Manufactured homes, if you've never done one, they're awesome. They are only available on renovation for FHA 203K. They are, for the most part, manufactured homes are priced accordingly. People get nice properties. They're easy to work on. There's just a lot of really advantages of manufactured homes. So don't be scared of them. I've seen people do 2 acres, 5 acres, get really nice pieces of property. Here's the rules. 1976 or newer, double wide is a requirement. Original set means it needs to be built from the manufacturer and moved to that property. You can never move a double wide. Once you move a double wide, they're not financeable because you've reduced the structural integrity of the manufactured home. It has to be on its own lot or it has to be in its own neighborhood, but it must be fee simple. They must own the land. No trailer parks, no mobile home parks. Those are not eligible. They have to be on single family lot and they cannot be age restricted. So you can't do a 55 and up manufactured home. However, you can do that for townhomes, single family homes and condos. You can do 55 and up. Mixed use property. A mixed use property is a property that has commercial and residential. The two most popular types of property you're going to see are 2-story buildings that are in town. So if you're in Tampa on Dale Mabry, You might see a little commercial building down below that might be a flower shop or a law office, and up top is an apartment. Those are the common in the city. When you get further out of town, you might find a commercial building out front on 301, Highway 27, Highway 21. It's a building, or Highway 30 if you're up in the Panhandle. Excuse me. It's a commercial building up front and a house in the back. Those are called mixed-use properties. Commercial lenders don't like them because they have residential. Residential lenders don't like them because they have commercial. Renovation lenders love them. So those are always a gold mine. If you can find them, I put a $sign next to them, because those are the people that we see that walk into big equity, just because they're so hard to finance. 50% of the square footage must be residential when you're doing a mixed use. So we can add on square footage, we can subtract square footage. We've had people turn the commercial portion back into residential because that was the best use and the highest value. So it just has to be 50% square footage. Okay, somebody asked you have to qualify in the total loan amount. Yes, you do. So on the mortgage side, when we issue an approval, when any lender does, we issue approval for loan amounts, not sales prices. So if they're approved for 350 loan amount, that's going to be the same for renovation as it is for a standard purchase. And then multifamily is nice. However, you must live in one of the units. You cannot buy multifamily as a second home or investor. Has to be primary residence. But the great thing about that, you can buy let's say a 3-unit property in Tampa or Miami. You live in one of the units, the other units count as rent and income. We count 75% of the projected income, even if there's no lease. So if you have a client that will consider it, I love multifamily. I think it's a brilliant and smart move. But for, let's say, a young couple or a young person, and they're just starting out their life, they want to have multifamily, best to do that when you're young and not making as much money, because we get to count the rental income as your income. So I love multifamily. It's the newest and hippest thing for millennials. They buy, like in Pinellas County, is half multifamily. There's so many units that have a garage apartment or a second unit, and it's a great way to accumulate wealth. And they love to Airbnb the back, and they're just so up and hip on that. The max debt ratio on any FHA loan, to my knowledge, is 55%. So it has to get approved Fannie Mae on the website, and it has to be approved automated. I've never seen a debt to income ratio above 55. Fannie Mae is pretty much 49.999. I've never seen one go over 50. I've never seen a front ratio go over 45 on a Fannie Mae, and we close a lot of deals. So those are pretty much, we'll say, your limits on debt to income ratios. So when everybody says that property is ineligible for renovation, it's just not accurate. Almost every home you're ever going to touch or look at or see or show is going to be eligible for some type of renovation financing. So how long do you need to live there? We talked in the beginning about a flip property. Who'd like to do investor deals next year? Who'd like to have a client, one investor deal a month next year? Okay. Let's say top 5 mistakes of realtors working with wannabe investors. First and foremost, understand what you're dealing with. When you get into a room and you have 1,000 people, there are only 50 that will qualify to be an investor. Rule number 1. Okay. So understand that being a real estate investor is the toughest financial thing to do to qualify. Number 2 is the best way to qualify to become a real estate investor is primary residence. So people make a mistake of buying their first house at 250 or 350, and they want to go backwards and buy rental property. Well, first of all, unless you have a tax return that shows that you have a history of being a landlord, you can't count rental income anymore. So that's the number 1 mistake, is that you can't count the rental income. They have to qualify for their house, their bills, their car, and the new rental property with no rental income being factored in. 99% of realtors don't know that. It's a new rule in the last 2 years, but it's a big time rule. Investors, if you want to be an investor, for the normal, average, everyday person, you buy your first house at 150, then you rent it out and you go buy your next house, pay 5% down as a primary residence at 200, and then 225, and then 250, and then 300. If you do that, you can buy one house a year for the rest of your life, and there is no cap on the amount of properties you own. As long as you are going up, as long as you rent the old property, we count 75% of the rental income. And then you can always buy as a primary residence. Fannie Mae has no cap of investment properties when you are a primary residence. So that's how you accumulate rental properties. Once you go up, you can't go back down. Now you have to put 25% down, qualify for the whole thing. And I'm going to tell you that 99.5% of the population flat out doesn't make enough money to do it. So that's mistake number one. Buy houses as primary residence, rent out the old one, go do another one. You can do one a year for the rest of your life. That's real estate investing. Second thing is you don't have to buy stuff by yourself. Many people are trying, you're trying to compete. Everybody wants to buy a rental property for 100 grand, borrow 25 grand. Now you're at 125 and flip it for 150 or 180. Guess who wants to do that? Everybody on the planet. They cash in their 401ks. They can qualify for the $800 a month because it's like a car payment. So you're competing with every Yahoo in the United States. You've got the guys who are part-time investors, want to be investors, don't know anything. And that's why your lower end buyers are having challenges, because those people are scooping up properties at above market prices because they don't know what they're doing. If you want to really invest in property, get 2 or 3 people together and go buy that $300,000 house that they can't compete with. They're not going to buy a $300,000 investment property, but that's where the money is. It's buying the house that's 1975, that's 3,000 square feet, that needs a total remodel. It's buying that waterfront house that nobody has touched in a decade. That's where the profit is. That's where the positive cash flow is. Those are the renters that are going to pay $3,000 and $4,000 and $5,000 a month for a rental property. Those are better qualified renters. They make more money. They have better credit scores. You don't have to have rent defaults. That's the plan. So get multiple people together. You guys create an operating agreement. Everybody's on the loan. Everybody's on the title. And you guys just have an operating agreement. But we do lots of deals. You can have max 4 people per investment property. So that's the other mistake. If you're a realtor and you don't have as much income on the books, get a partner. You got a buddy who's a lawyer or a doctor or makes good income. You guys have a joint. Your expertise is finding the property, getting hooked up with the lending and getting the contractors. You're 50-50 partners. They make the money. Okay. So try to get people in to do that. They have to own it for 1 year is our rule. Now that's the rule on any single property. Any of your clients or you, when you go to buy a property, you actually sign that 1 year affidavit, and it's been there as long as I've been in the business. So you're guaranteeing that you're going to occupy as a second home, investor, primary residence for at least 1 year. After 1 year, you can do whatever you want. If you make, now that 1 year is from closing date. So if you close May 15th, it takes you 11 months to fix up the property. You got to hold it 1 more month, then you can sell it. Okay. So it's based on closing date to closing date, or closing date to list date. Now, remember, this is high tech and computers that you want to stick to that year because you don't want to get yourself in trouble. All right. Now, the rule with primary residence, you have to be able to occupy within 60 days of the completion date. Now, that might be 6 months out. So if you have a lease, you might want to keep that in place and then move in when it's finished. So if you're doing a 6-month renovation, you only need to keep it for another 6 months. Now, if you wait 2 years, I don't know how long this is going to last with the current political environment and who's in charge. Capital gains is a great thing. It's been around for decades now. If you hold it for 2 years, you flip it and sell it, you pay no capital gains. So the last house we just sold where we made 190 didn't pay a cent of income tax. So this is a great way for people to accumulate wealth. Now, I'm not going to promise that that's not going to go away. Current elections, and I'm not here to be political. I'm just saying that the one that's in charge right now wants to get rid of that. So use that as long as you can. If you have clients that are at their 2 years, they should sell their house now because that's not going to stick around for very long. So it's another way to get people off the fence. I would be broadcasting that this capital gains tax is probably something that's going away. So a great way to get more listings. Okay, so, and that's for primary, so it's not for investors. So just want to let you know. Okay, so these are all the loan programs side by side. I wanted to put them side by side so you can see them next to each other. So FHA 203K, let's go right across the board. All three are for purchase or refinance. FHA and VA are primary residence only. On a VA, only a veteran and their spouse can be on the loan, no co-signers. On FHA 203K, you can have your parents, your brother, your sister, your cousin, your best friend from college, all can be non-occupant co-signers. People forget about that, but if your client doesn't qualify, their parents might be able to help them qualify. So just remember that. Primary residence only, 3.5% down. Fannie Mae Homestyle has 4 different types. First-time home buyer, 3% down. Multiple properties that they've ever had, they have to go 5% down. Condos must do 5% down. Second home is minimum 10% down. Now, a second home, they have to occupy a certain amount of days per year. IRS, I think, says 18 days. We just don't want you doing a long-term rental. So you need to occupy as a second home. And investor, the guidelines are 15% down, but understand nothing is happening unless it's 25% down on investors right now. Fannie Mae has put out some warnings about the investor concentration of loans, and they foresee some financial difficulties. So in Tampa, you'll see it. There are just tens of thousands of apartments that have been built, investment properties. And I'm throwing out just an alarm so you know for your own personal self. I'm going to guess there's probably 50,000 units built in Tampa over the last 5 years. That will have an impact on rental income. Now, some people don't want to live in an apartment, so houses are always going to be a great thing. But we'll just tell you, Fannie Mae has thrown out the alarm clock that they want more money down. They want better clients on investment properties because they see a risk coming. So you guys should be aware of that that's just a super saturation of rentals that have come. And Tampa is a good example of that. Okay, minimum credit score, 580 is the minimum credit score for FHA, is what it's announced. 620 for conventional and 580 for VA. Understand there might be some overlays with that because of COVID. They jacked it up to 700 and 720, and now it's back to pretty much 620 for almost everybody. Max loan amounts, there is no max repairs. So if you bought a house for $1 and you wanted to borrow $356,000, you could do that on FHA as long as you leave the foundation, as long as you leave one wall standing. No max repairs for Fannie Mae Homestyle either. So have at it. You buy a 2-bedroom house, you want to turn it into an 8-bedroom house, as long as it appraises, you're going to be fine. Renovation period is 30 to 120 days on FHA. That's 270 days on Fannie Mae Homestyle. And VA, when it comes back, is different. It's 90 days. They only want that to be very fast, very quick, get the veteran back in the military. They don't want them to be dealing with room additions, structural repairs, any of that. So VA is just the cosmetic stuff, the roof, the plumbing, the electrical, flooring, that kind of stuff. The 203K inspector is required on all 203Ks and Fannie Mae Homestyles above 15 grand worth of repairs. I will tell you as a hint, if you've ever heard about 203Ks taking a long period of time or not closing on time, many lenders take 90, 120, 180 days because they don't know what they're doing. Here's the rule. Don't ever do a renovation loan without a consultant, period. You want to know in the first couple of days what's a needed repair. You don't want to rely on the contractor to tell you that. Appraisals always catch other stuff. Use a 203K consultant. I suggest you use a 203K consultant on any deal, every single deal. And here's why. When you go in to do a FHA deal, and I'm doing a regular FHA loan, if I have to switch from regular FHA to 203K, I keep the same case number. It goes to the same underwriter. I can continue to underwrite it. All I do is a change circumstance form. It takes me 5 minutes. And now you get a contractor bid and I order the appraisal. You haven't lost any time. You're still probably going to close on time as long as you have a 203K inspector. So that's why I like them on every deal. It will simplify your life if you start using these guys on every deal. And if you have a inspector you like to use, encourage them to get improved. It is a great product for them because the programs are rocketing up. They don't want to be left out, and they can make really good money on it. 1 year assumable loan. FHA and VA are both assumable after they've been there for a year. And then all Fannie Mae and conventional loans are not assumable. Eligible improvements. I've got some listed up here I want you guys to look at. We've already talked about roofing, electrical and plumbing, driveways, sidewalks, handicap accessibility. We can do patios. I want you to write this down. Pool repairs are eligible for all three. You can only add a pool with Fannie Mae Homestyle. Now, is pool a big deal? You want to get some business? Start talking about pools to your customers. Pool, you never add a pool to a $150,000 house. You add it to the $300,000, $350,000, $400,000, $500,000 home. Here's the other great things I can tell you, and I can tell you this experience. Candace can say the same thing here. When you get up into the upper sales prices, a pool is not a $15,000 adjustment. It's a $35,000 to $50,000 adjustment. Because when you're in a group of 8 homes on a little cul-de-sac and 4 have pools and 4 don't, the ones that have pools are selling for $550. How much are the ones selling for that don't have a pool? They're not selling for $530. They're selling for $480 and $470. Because when you get to a certain price range, not having a pool is like not having a garage or not having a third bedroom. They can become an expected feature. We just had an appraisal. We do a lot of renovation loans for refis, people adding pools. And the difference between the pool home comps and the ones that are not are night and day. They're 60, 70, 80,000 higher because in certain neighborhoods, they're just a necessity. We live in Florida. Okay, the pools can be a big deal. You want to attract a customer, tell them just that. Hey, I can find you the pool home, but there's 10 offers on it. Let's go next door and get that home, design your brand new home or a brand new pool for 50 grand. And you get to pick out your pavers and your LED lighting and your special pumps and that kind of stuff, heated pool, whatever. Okay, so Fannie Mae Homestyle is the best product in the world to add a pool because pool financing, 5, 6, 7%. Termed over 15 years, it acts like an equity line. Once you place an equity line on the home, you are subject to cash out rules for Fannie Mae. Do not get equity lines on homes. Fannie Mae is encouraging you not to do it. They're limiting it to 80% anytime you touch it. They're hitting you 1, 2, and 3 points for cash out rules because you have an equity line. Do not allow your customers to do equity lines. They will pay the price for it at some point. So just a good suggestion here. You can turn carports into garages. You can add bedrooms, add bathrooms, add second stories. You can do electrical upgrades, dig new wells, septics, anything. Anything on here that you can think of can be added. You can, Yolanda, please just send a chat. I'll look for your questions since you're raising a question. And I'll answer that right at the end. Architectural plans, bathroom remodels. The best deal in real estate is a 3-bedroom, 1 bath because they sell for significantly lower than all the other properties. And it costs about 25 to 30 grand to add a bathroom inside a house. And if you're going to do it on the outside, you're going to add a laundry room and a bathroom combination. Target market. So how many numbers are on the Powerball? Everybody give me an answer. And we're right here at the end, so we'll be done here in a few minutes. How many numbers in the Powerball? If you pick 6 numbers, you win 100 million, 500 billion. Last year, $1.3 billion if you pick 6 numbers. How many choices does a customer have to make to buy a home? Isn't everything we're looking at here a choice? The difference between Candace and how she wants her kitchen and I do is different. How you want your pool is different than the other customer. What flooring you like, all these things. We're in the very unique business of selling somebody something where many of the choices have already been made. Is it possible to find somebody a perfect house? No. Even if you built somebody their perfect house, generally they're not going to get everything they want because there's going to be limitations. Stop trying. What we're doing with renovation loans is opening up your target market. If I have a customer that wants all hardwood floors in the house except for the bathroom and the kitchen, there might be 1 in 1,000 that has that. I don't take them to find that house. I take them to find this maroon section here, which is all the house that needs flooring. Maybe I take them to a property that was a rental property. It's all carpet and it looks like a CSI crime scene. Are those usually priced effectively? Sure they are, because anybody walking in can see this house needs new flooring. I take your hardwood customer to that house and have them buy that house. That way you get your all hardwood floors, you get your Brazilian walnut, you get anything that you want when you're done. If I have a customer that's a gearhead and wants a 3-car garage and I just can't find them one, I find them one on a big enough lot that has a carport. We convert the carport to a garage. So maybe that's this orange section right here. And maybe I'm looking for a house like South Tampa and Plant High School District. The prices are through the roof. A base house is like 500 grand right now. Maybe I find the 3-bedroom, 1-bath house in Plant that's selling for 400, and I put in an extra bathroom and laundry room combination. So I get into a neighborhood normally I wouldn't be able to afford, or I find that house just isn't in disrepair. That's right down the street. So all renovation loans are doing are increasing your target market for your customer. Your customer that's super picky, I'm going to tell you, they probably need the house that needs to be gutted, because you're going to find them out there. They need new drywall, they need air conditioning, they need to be gutted. That's the home for your customer that's super picky, because they get all brand new stuff. So that's what we're doing by increasing their target market in renovation loans. We're going to finish up this in a few minutes. You guys can check out at any time if you want to. If you want to stay on, I'm going to continue here for a few more minutes, but your CE class is complete if you wanted to check out. I've just got a few more slides, so I'll be probably 3 or 4 minutes at most. Here's a sample construction agreement. You'll see that they're breaking out labor and materials for each line item. What we do is ask the contractor to do allowances for every item. And that way they don't have to choose what sink they want, what flooring they want. They'll just put allowances on every item. You'll notice it starts within 30 days and finishes within 180 days. This is a 203K worksheet. Only the thing that we're going to go out to you is see that we're going to put renovation costs, we put contingency reserve, all their inspections, all their permits, any architectural engineering costs, everything is rolled into the loan. So we will put everything in the repair escrow. This is not out of pocket for the customer. We want this to be super inexpensive for the client. So all these construction related items are financed at 100%. The next is the process, and this is what we're going to finish up on. First is a loan application, a loan approval. I would suggest you guys always use a full loan approval where somebody is using all their tax returns, W-2s, pay stubs, divorce decrees, anything that's internet, online, be very skeptical of it. They don't look at all these docs. They don't send it to underwriters. Just be skeptical. Visualization. We are in the real estate business. You guys have vision. Many of our customers, 90% of them don't. Have them watch these TV shows, have them go to Home Depot, have them select out flooring, have a little notebook for the things that they're really interested in a home, because it'll make them easier to show a home that needs work. Older homes have small closets and big bedrooms because we used to have bedroom furniture. That's different today. So you don't need a 10 by 30 or 20 by 30 master bedroom. What you really need is 10 by 12 closet. So you want to show them closet systems, get them to look online, have a visualization of what they can do to a home before you put them in your car. The next process is the contract. I want you all to do a 45-day contract on your first 203K. That's 10 to 15 days on inspections. It allows you to get your contractor estimate, but understand we need the full inspection and the contractor estimate before you order your appraisal. So it's important that that all be finalized. You really need 45 days until you have your team in place, and then you can start shaving those days off if everybody's on the deal. Closing is what happens next. You're going to close on the house. It's as is. You're closing, your seller gets paid, you get paid, the loan officer gets paid, everybody's done. Now it's between the contractor, the inspector, and the homeowner. This is where most people drop the ball. For those of you who aren't sending personal thank you cards, I want you to start doing it. You can pay somebody $2. They will write you a personal handwritten thank you card. You also get one phone call to your customer. This is a time you call them, just thank them for the business. Hey, this is how I feed my family. Our employees really thank you. Send them a little gift. Send them anything of value. That's 3 contacts. But you guys are in the consumer business. This is the best opportunity in renovation to keep in touch with your customer. I'm not suggesting that you go in and call the contractor or do whatever, but maybe call the client. Hey, I saw the roof went on. Did they show up on time? Did they clean up after themselves? Are you happy with that roofer? Because I'd like them to refer them another deal. The kitchen goes in. Hey, I keep notes on all my past customers, and that way I can update the MLS when they see your property sold 50 grand below market. I want to put it in the MLS that you did a renovation loan, that you're doing $80,000 worth of repairs, so that it helps inflate the values of all the other properties in the neighborhood. You're helping out the neighborhood. You're helping out your past customers when they do that. So properties will continue to rise and they don't use that. But it's a good way to have another contact with a customer. Maybe the final one, you take those notes on the what they did with the kitchen and the walk-in, that type of thing. And then if it's a huge renovation and it looks significantly different, before picture, before an after picture, get them a nice frame photo, your business card at the bottom, their closing, their name and address on the top. Present them with a nice photo. They'll hang it in their house as long as they live. But here's what I do know about renovation and what I learned in 1993. I specialize in renovation because I get more business because of it. I increase the probability that they're going to find a deal. I increase the probability in the closing time because we don't have to compete with everybody else. But most importantly, the people that do renovation are the people that are going to give you other deals. They go to their office. When they have their plans done, when their appraisal comes in, they're shouting it out on a soapbox. They got new appraisal done. They planning out their new kitchen. These are the people that are telling everybody about you and what they're doing. I get their sisters' loans, their brothers' loans, their coworkers' loans, their bosses' loans. I built a whole career for 29 years on doing nothing but this because it's my favorite loan. It's the favorite. It'll be your favorite purchase too. But these are the people that refer you more business. You became that realtor that knows what they're talking about construction. You found out how much it costs to be priced per square foot on a roof. You helped a client get into a neighborhood they would never afford. You helped somebody walk into, like me, $130,000 worth of equity the day they finished the project. This year was the biggest appraisal I've ever seen. We did one down in Naples, 4,000 square foot home. They bought it for 300 grand. They put 175 in it. So we're at 475. It appraised for 650 when we did the loan a year ago. It just appraised again for 825. $825,000. They've got 475 in it. Show me anything that makes that much money for any client. There is nothing like this. I would hope that you guys engage in this. You guys are always welcome to call any of us and ask questions. Send me an email, attend another class. I want to thank you guys for letting us come in and teach you today. I hope you get as fired up about it as I am. I'm in it 29 years. I'm fired up. I never use an alarm clock. I love to get up every day and start my day because we're helping contractors and home buyers and listing agents and sellers. What we do helps everybody. I hope you guys engage this and use it in your program. We will send you a survey. So if you could please fill that out, ask you for a review, any comments about the class, how I can make it better, something we didn't go over. I'm glad to help, but I really hope you guys have great success in 2021. And I want to thank you for letting us teach. I'm going to stick around and ask a few questions. I'm going to take a 2-minute break. And then if you guys stick around, I'm going to go in any questions you have, throw them in chat, and I'll stick around for questions. So give me 2 minutes and I will be right back to answer any questions.
Hey everyone, thanks for coming. If you didn't register ahead of time, just send one of us an email, get with the person that invited you, and they'll send you a link to their registration link. You need to do this to get credit for DPVR's CE. All right, thanks so much. Take care.
Okay, guys, I'm back. Sorry to take a quick break. I'm going to try to scroll this backwards for the questions. Let's see. You can rewatch this class. We have recorded it, and we're going to send everybody the link within the next couple of days. It takes about a half a day just to get it back, and then we're going to get everybody's hours logged in, and we will get everyone a copy of this link. So rest assured you'll do it. You will get that. And yes, you guys can reach out. If Candace invited you to the class, please reach out to Candace with any questions. Same with AJ and Jason Powers. We're all a team here that can answer any questions about these classes and any questions that you may have specifically about buyers or anything like that, or have any income questions, they can help you with that as well. And if I invited you, please reach out to me as well. And so let's see, any other, I just wanted to sell because I found they wanted to do own a home now and do not want to sell it. So if you own a home now and you want to go buy another property, 203K, you actually have to go Fannie Mae Homestyle because we'll let you rent the old property. FHA does not allow you to rent your old home to qualify. So you'd have to qualify for your old one and your new one. Fannie Mae will take 75% of the rental income with a lease that's effective 60 days after closing. So if you go conventional and do the Fannie Mae Homestyle, you can rent your old home and go buy a new one. Okay, so the specific plans so great question. You do not have to have permit-ready plans to order the appraisal. We need a floor plan with measurements, existing and proposed, and we'd like to have elevations if possible. So if you're doing a second story, elevations are like pictures of the house. Like, what does it look like? Front, back, sides. Here's what the second story is going to look like. We kind of need that on a 2-story. On a 1-story, we only need existing and proposed floor plan with measurements and square footages. Because let's say we're taking it from a 1,500 square foot house to a 2,000 square foot house, we want to factor that in. We're going from 3-bedroom, 1-bath to 3-bedroom, 2-bath. We want to factor that in. So we only need the floor plan to order the appraisal and get through underwriting. Your full plans can be done after closing, actually. So, because there's always going to be those little tinkering things, and getting to between the contractor and the architect, they're always going to be fixing something. So it would be almost impossible if we waited till you've had permit ready plans, because you're going to go back and forth with the city. You might need to add something, subtract. And that's also why we have our contingency. So if you're doing $150,000 renovation, we got 15 grand just sitting there for anything the city would say pop up. Oh, you need to do a curb here. Oh, you need to pay for the stop sign that just got put in. You never know with the city, but that's why we have contingency. All right. If the reno goes beyond the contingency, that's a great question. So the buyer when you're getting to the end, and let's say you're running out of money, let's say you're in this project, you're in it 6 months, you keep adding things and adding things and adding things, you're about to run out of money. You can work with the contractor at the end to possibly put materials on a credit card, figure out some way to finance the materials, go get a Home Depot card, or make a credit line where you can get the materials, and then you pay cash to the contractor to fund any difference once you run out of money. That being said, once that project, it's probably a better idea to do it in stages. And I have one that we're closing right now. We're going to do minimal repairs to this house. That's about I think the purchase price $450. We're going to do about 30 grand worth of repairs today. But next year, when they go up in the loan amount again for Fannie Mae, we're going to do the room addition. So you can do this in stages as long as it's 1 year each time. So you can do the 30 or 40 grand just to get you closed quickly. Seller won't wait around for you to do plans. Go get the roof done, some other things. And then phase 2, give yourself a couple months to draw up plans with your contractor. And then next year you do the room addition or the second story or add the garage then. So I have multiple people doing it that way now because sellers don't want to wait around for plans to be done. So that's a good strategy. And yes, then you get to use the new appraised value. So after a year and the house has gone up by 10% or 15%, we get to use the new appraisal. So we do a new appraisal after a year. You cannot repair sinkholes with these products. However, you can finance a previous sinkhole that's been repaired. So we do allow sinkhole repaired houses as long as they've been certified. The problem is you never know what that hole is going to be. And I've had a house that had a sinkhole. Actually, classified as that. It ended up being not a sinkhole, but it was $130,000 worth of repairs. Until you start fixing it and get engineering reports and all that, it could be 50 grand, it could be 150. That's why we want it done, certified, closed out, and then we will let you get a renovation loan on anything but. Now, that being said, we do lots of repairs on foundations. Don't be scared of foundation repairs. They are much less expensive today than they were 25 years ago. You might have to lift up a corner of a house, do a new knee wall, or fix the cracks in a wall, or all that kind of stuff. Everything's significantly less expensive today because engineering is better. They have better products. More people do it. There's more engineers out there, more contractors. So if I did a corner house of a repair in 1995, back in 95, that's 50, 60 grand. Today, that might be 20. And that's with inflation included. So literally, it's almost like a fifth of the cost of what it used to. These underpins that they've used for sinkholes are now being used just to repair corners of houses and that type of thing. So you used to have to pump it full of concrete and truck after truck after truck, backhoes, all that stuff. Today, they'll come in, they'll drive a couple of pins in that hit the limestone underneath, secure it up with bolts, and you're good to go. The last house that I did end up doing every 4 feet, they call them heliarc poles or whatever, but every 4 feet around the whole house. And literally it sits up on stilts. We didn't pour any grout and any concrete. So it saved a lot of money. So never be afraid of foundation repairs. Okay. Sinkholes. When we do this, you will be able to see the video and the audio. And you guys reach out to your old clients. This is a way, so now on a refinance, it can't be listed and they have to hold it for at least 9 months after they do the repairs. So if you have customers that never did the repairs, reach out to them, tell them about the program. They can go do the kitchens and the roofs and all that stuff. Or if you know you have a customer that's going to be, they know next year their kids are graduating. So my daughter's a freshman in college. Let's say you have a daughter or your client has a daughter or a son that's about to be a senior in high school and you think they're going to move next year, man, they should go do this now. Fix the kitchen, do the roof, fix all the stuff up, make it immaculate. So your listing is the one that has 10 offers today. You put it on the market and you've got highest and best going out within a few days. But this is a great product for refinancing if you know your customer is going to need it, sell it in a year or 2 years or whatever. So great question. Okay. All right. So are you able to get a renovation loan after occupancy has been over a year, but refinanced 6 months ago? So here's what I tell you, just to be fair to our business partners, is we would want your client, they're already at 6 months. 7 months is usually the repurchase agreement for many lenders and brokers. So we would want to wait 7 months so we're not harming the old lender. So once they get to 7 months, we would be glad to help them refinance. Okay. If it's FHA, they have to wait a year to use the new appraised value. If we're going Fannie Mae Homestyle, the rule is 6 months. We would want to wait to the 7th month because we wouldn't want somebody to have to repurchase. And what happens on the lending side is if one of our clients does it and they refi in the first 6 months and let's say 29 days, we got to stroke a check for 8 or 10 grand to the lender because it prepaid. So to be fair to the old lender, once they get to 7 months, we'd love to help them. It has to go Fannie Mae if it's within the first year, and then it can go FHA after 1 year. We get to use the appraised value. Once we go 1 year, they get to roll in closing costs and everything else can be part of the loan. So great question. All right, let me go down here to the bottom. So you're supposed, when you purchase a new home, you sign a 1 year affidavit. So we want them to wait 1 year to go through the repairs, do everything they're due. And then after a year and 1 day, they can sell, they can rent, they can do another renovation. That's what our goal is. On somebody who is previously financed, I want to wait 7 months because that's the repurchase agreement. Now we can do a 7-month refi if they've been in the house for 7 months, as long as we're going Fannie Mae Homestyle because they only require a 6-month waiting period. FHA requires a 1 year waiting period. So they would have to have bought FHA last year and go 1 year, then they can do another one. Conventional, the rule is 6 months. We would want them to wait to 7. Does that answer the question, Sandy? Okay, good. Okay. All right. No, 6 months is from their original closing date, 7 months from their original closing date. Now the reno must be completed before we take a loan out because they have to have had all their draws executed. They have to have a final inspection and all closed out from the old lender. So that's why we typically wait a year, do it in phases. So we'll do like what I'm doing right now. It's going to close May 14th. They're going to do about 30 grand worth of repairs. They need a roof, some electrical, doing a couple windows, and they're going to open up a wall to make it livable for a year. And then they're going to start with the contractor and the architect working on plans for the room addition that will happen next year. So that's kind of the best way to do it, but it's closing date, not completion date. So they must be complete, all the repairs, final inspection done, all the money released. And as long as that's over 7 months ago, they'll be okay. All right. Okay, guys. Well, listen, thank you so much for allowing us to teach today. Like I said, please reach out to any one of us, Candace, AJ, Jason Powers, me if I invited you, and we'd be glad to answer any questions. We'll get moving on getting your class hours registered. We will get working on emails so we can send you out this recording when it comes. And like I said, please call us if there's any questions or any way that we can help you. And thank you again. I hope you guys embrace this. I know it to be successful. I've never heard of a single person that engaged this process and renovation that did not have success. It's just, you're never going to meet a person that isn't interested in making the home the way they want to make it. So I want to thank you guys so much for letting us come in.
I have a question, Andy.
Okay, go ahead.
I came across an MLS listing this morning, and it looks like the house is it's got tile floors in it. It's a renovation that's not finished. They have a floor plan. It seems like they have an architectural plan, but they have it listed as it's unfinished.
Okay.
can this go 203K for the buyer?
Yes, both 203K and Fannie Mae, because it's an existing home that they were already remodeling. So yeah, it can be in any condition. So lots of them are people that gutted a house and couldn't finish, like they ran out of money or lost a job or whatever. But yes, those are the gold mines because they've already been gutted, you know what I mean? Or they already were planning on going that way. So then you just get to finish it out. We just need to make sure the price is effective to complete the home. So
So
homes-
my buyer could come in there with a 203K inspector guy and finish out the plans to their specs and
Right.
move forward that way.
correct. Yes.
I'm gonna hold an open house on this house and see what it's just
Yes.
because.
Okay. Good plan. You'll get other buyers because of it. So,
Yep.
all right. Thank you, Cindy, for the question. Anybody else? And you guys were at the point where you could just click on mute and ask a question if you like. That's I don't know how to pronounce your name, Raquelina. If you send us an email, we'll try to get, Rocky, hey, Rocky, we'll try to get you somebody who's out of state. Let us know what state it is, and we'll get you referred to one of our lending partners, and they'll find somebody like us at any other state. Okay, so we'll try to help you do that. We're kind of bullish on the lenders we work with. One of them for me is 15 years, the other one 12 years. And we just like those relationships. So they're just rock solid. And we like to refer people that appreciate them as well, because they're really good. And we want to repay that favor because they do refer us stuff here in Florida. You know, if they have a realtor that's in New Jersey, they'll call and say, hey, we help this client, they're moving to Florida. So we like to be able to repay that favor. We can't do shared income like you guys can do because it's super regulated. So, but we like to repay that favor with referrals. So we're glad to help hook you up with somebody. And Rocky, send me an email and we'll get you hooked up with somebody. Mine is awood@titanhl.com. So I will put that here in the post. awood@titanhl.com. So just send me an email and tell me what state it is, and I will copy you an email to them. Maryland, my hometown. Yes, I absolutely can refer you to my old company. And so good friends. So be glad to help. That's why I started this. All right. Okay, guys. Well, thank you so much. We'll stick around here for about 2 more minutes. If you have any questions, you could send them on chat. And like I said, please fill out the surveys when we send them back. If you guys can review us, we're going to send you a Google link. That's how we get invited to all the associations, is our performance. So, and let us know if there's anything we can do to improve or something you missed that you'd like to go over next time.
I have a question.
Yes.
With realtors, how would you qualify them with 1 or 2 year tax returns?
So it's 2 years tax return. So we take the most recent year or 2-year average, whichever is lower. So hopefully it's upwardly trending, but yeah, we use 2 years of full tax returns. The other COVID rules, which is not just realtors, it's any self-employed people. You want to make sure that you have closings going on. So they'll look at year to date. So you want to make sure that you're depositing any checks for any commissions you're getting. Make sure you're having deals going. I just had that happen to a client where they have a business and kind of seasonal, but they hadn't had a deposit in a couple months, and it's becoming a challenge. So try to make sure that that's moving. So and that's any self-employed. If you owned, let's say you were selling ski boats or whatever, they'd make sure you have sales every month. So now we're required, because of COVID, to look at the last month, the month before, 3 months back, to make sure your deposits are consistent with your average income. So those are some extra rules the government tacked on to make sure that people can qualify today. And somebody asked a question too about cash financing. I love to see people that have listings that say cash only. It's my favorite. Okay, conventional only or cash only. It means the house needs work. Okay, and then what we do on our end is we send an approval that basically says that, hey, if this is a cash only house, if this is conventional only, this is the best product because this is an as is renovation product. So the house can be burning down, water damage, sitting on its stilts, whatever. We will close it as is, which is way better than any type of conventional financing. Cash buyers are, yeah, cash buyers are cash buyers, but they still do home inspections. They still need homeowners insurance, and cash buyers like discounts. So for the most part, generally our owner occupied buyer is going to pay more than a cash customer anyway. So yeah, I love to see that on listings when it says cash only, because that's how, and then usually that listing agent doesn't know about the program. So we end up getting a contact there and it helps. And yes, this, and another thing that we do is when we put together a pre-approval, we get on a joint email and you copy the listing agent and say, hey, I understand this is cash only deal. Our guest, you know, in looking at it, property needs work. I'd like to introduce you to, here's the originator that's working on the deal. Here's his experience. Cash only can truly almost be like cash only because the condition of the property is irrelevant as long as we're going to do the work and put in an escrow. So literally, like I said, it could be just one wall and everything else is burned down. And we've done burned down houses. We will close as is. So once the listing agent understands that, they'll know, wow, maybe we should go ahead and let this go as a financing deal. Okay, guys. Well, thank you so much. I'm going to step out here. We'll get this recording ended so they can start moving it forward. And thank you guys so much for attending. Nice to meet you, everybody.